All right, good morning, everyone. We're jumping into our Chapter 21, but before we do that, we are going to be doing our Chapter 20 practice problem review as well. I'm going to start with a really quick anonymous poll, so bear with me while I share my screen here. I'm going to make this poll anonymous so that no one feels pressured one way or the other. It just gives me some additional information so that I know how much we need to get into details versus how much I should be spending on new material. So I'm going to allow everyone to annotate. And what I would like you to do is give me an idea with whatever color you like, whatever mark you would like to put in, which of these boxes you fall into. So are you currently up to date on your practice problems? These are the DT Max problems. Are you working your way through them, but you haven't quite caught up to the end of the Chapter 20, or have you not started them yet? I'm going to give everyone a minute to fill me in there. It does give me an idea if I'm demonstrating things that you haven't tried yet, or if I'm pointing out things that you haven't practiced yet. It tells me the pace that I need to go. Give a few more people. We have 1, 2, 3, 4, 5. I should have 3 more. Also, if you're not comfortable with the annotation tools, you can send me a private message if you prefer. But I'm going to see, looks like we've got most people are up to date. Excellent. So what that's going to do is it's going to give me an idea for how quickly I can go through these practice problems and what things I need to be focusing on. That should give us a little bit more time in class for new material and for me to add a few of the extra things as well that I like to add to give you that real-world perspective beyond just doing data entry. Excellent. Thank you very much. I appreciate that. So I'm going to stop this. And we're going to jump into our Chapter 20 at the very end and take a quick look at the practice problems. There were 4 practice problems for this chapter. And if I remember correctly, we did some of our RSP practice as well. I did warn everyone, make sure if you viewed your RSP theory, we're going to be getting into the difficult stuff today as well. But this is our last chance to take a look at some of the easier RSP data entry. We had George, who is single. He had a profit sharing plan, so we're going to have a T4PS slip. We did have some estate income, so we have a T3 from that income. And we had some RSPs that he had contributed to with a receipt. Quick note here on the T4PS, he is not a specified employee, so it's going to be a fairly straightforward T4PS. You're going to treat it very much like a regular investment slip. He's going to have dividends, he's going to have capital gains, he'll have some other income, but you don't have to worry about some of the extra complicated special taxes in this case. So in a real world scenario, if you should be checking your box 40. If you have a specified employee, that's a scenario where you might want to get a little bit more help. But if it's just a regular T4PS, these we're seeing more and more frequently now. These ones you can treat very much like an investment slip. A quick reminder to everyone, because we don't see a lot of them, but they do happen. Anytime you have a T5 slip, I want you to look for foreign currency. There wasn't in this case, but just a quick refresher that sometimes your T3s, more often your T5s might be reported in a different currency. So keep a quick eye out for that when you're doing real world cases. All right, what did we have for this one? So we had George Raymond with a balance owing. Did want you to confirm that election said no, so you should be looking at your second page. I gave you a whole bunch of line numbers. One of the reasons I'm giving so many line numbers is that if you're having a problem getting the right answer, I have pre-selected the lines where you may have missed something or your data entry may not have gone correctly. So you should always be doing your data entry and then looking at the tax return. You should always be doing your quality at source. I will say from having done, and this isn't necessarily a comment for anyone currently in class, but I have been having some emails where students are sending me their questions saying I'm not getting the right answer. And when I look at their exercise, I can see that they haven't done their quality at source. And I can tell that they haven't checked these line numbers because usually what I'm telling them to fix is you put something on a line number that I said should be blank, or you're missing something on a line number that I said should have a number on it, it's going to help you zero in on where your data entry problems are. So always remember, we're sending in a tax return. We're not sending in data entry to the CRA. So you need to be checking these things. If you check these things and they're all right, you're probably going to have the right answer. All right, I am going to do a little bit of checking on the Schedule 7 for this one because I want to make sure it's your first chance to see one that you've done on your own. And I'm going to point out the data entry lines as well, just reminding how we want to do best practices for quality at source, and then we're going to check our notes. So let's do those things now. I'm going to find my George Raymond file, which is here. And when I go to my Schedule 7, if I have done my Schedule 7 correctly, I should have no carry forward or no undeducted contributions. I should have one contribution that was made January to March, so January, February of this year, and then it's going to be designated as a repayment because he was required to make a repayment. It's going to designate what it can. He will get no RSP deduction. And of course, if I remember correctly, his repayment was supposed to be higher than that, which means we're going to have some RSP income for the difference. So the computer should have handled that correctly. For the data entry side of things, we're only going to enter the information that is required. In this case, we're going to put, and again, I'm going to stress this, government HPP information is going to give you the correct data entry so that it will e-file. It will not e-file if you pick anything else. So government HPP information, then withdrawal, outstanding, required repayment. I don't need to designate a $400 repayment. The computer will do that for me. The computer will know that it can't designate more than that because we've only entered one receipt. So from a data entry perspective, it matches what I've done on the tax return, but it's done it in an efficient manner. And similarly, when I'm taking a look at my tax slips, everywhere where I have dividends, I'm only going to enter one box of the dividends because I can make mistakes when I enter more lines. And so similarly for my T5, I'm only going to enter one box for the dividend, one for the interest. Anna Marisa, are you deducted marks if you designate a repayment for home buyer plan? I haven't checked on the marking scheme for that specific item. I can tell you that we may be deducting marks for some of these extra data entry ones. So definitely for your tax slips if you're entering extra ones. I suspect not, but what I am going to say is there's preparing for the marks and then there's preparing to do accurate returns in an office. When we're putting more data in that we don't need to do, we make mistakes in an office. It is so easy when you're going really quickly, and I'll tell you the last week of tax season can get really crazy. It's so easy to put a decimal place in the wrong place or hit tab before you wanted to hit tab and go to the line too early and end up with the wrong number and not catch it. So practice doing returns in a way that reduces the number of mistakes you can make. It's going to save you time on your problems as well. All right, so that is George. Generally speaking, I'm going to go into my comparative summary here so I can see his income. He did have a balance owing. It makes sense that he did. I was expecting one. I can tell you just from looking at the income line numbers, I'm expecting him to owe. Let's see if we can come up with an explanation for the reasons that he owed. So I'm going to ask you to type in the chat window, what are all of the notes that you added? Because we needed a number of quality at source notes. What caused him to owe money over $500 on this return? Okay, so there was a home buyer plan repayment that was missed. Very good. There was dividend income. There was income. There was capital gains income. We're looking for income. So remember, you have to separate out when we're asking you to explain a balance, it's going to be different than when we're asking you to explain a refund. So charitable donations, things like that, medical expenses if he had any, that's not going to explain him owing money. That would explain him getting a refund. So we're going to leave those ones off. If we're doing balance, we're looking at why does he owe? It'll come in two places for balances owing. So this was a good one to practice because um, with this particular scenario, we have a lot of different things for income to look at, and we don't get enough practice in the course for balances owing. But in an actual real-world scenario, we definitely hit a time of year where we start to see more and more people owing. I will tell you, there's a flow to tax season. So what happens in tax season is in February, we get people who have very straightforward returns, and they want their refund right away. So that's what we get in February, usually fairly straightforward returns. When we hit March, we start to get people that have some of that retirement income, and we get more families in March, and we start to see bigger refunds because we're dealing with elder dependents, and we're dealing with childcare, and some of those additional things. Also, some of our big donators come in March when they have all of their receipts together. So they'll usually have investment income, retirement income, and then they'll have like large charitable donation receipts. So we see those refunds coming in March. And then when we hit April towards the end, that's when the people who know they're going to owe money start coming, because they have to file, but they're not going to get a benefit. They're going to owe. So they leave it till the last minute, and then they start coming in April. So we tend in this course to see a lot of refunds because we're practicing that type of return more, but you are going to need to know how to explain these large balances owing. The second place you'd look, so you always look for income that did not have tax withheld or didn't have enough tax withheld. You're also going to look for clawbacks. Anywhere where there might be a clawback will be an explanation for owing tax. And then at the very end, you may take a look at how much was deducted at source and find out in that circumstance, is there a reason why it's low? So if all you have is one T4 and they owe money, that's not supposed to happen. We need to see what the employer did. Sometimes the employer took the wrong amount off. So we'll see those as explanations as well. All right, I'm going to show you what I had for my notes. So I had other employment income, dividends, interest, capital gains. The other employment income, by the way, was from the profit sharing plan. It was profit sharing plan income. So if you said profit sharing plan income, that's fine as well. So that's dividends, interest, capital gains. Homebuyer plan repayment not made, and then other income, and I like to specify what it's from. It's from investments. All of those are things that had very little or no tax taken off, so he has to pay the tax now. Good, and then just a reminder for check marks, you want to check mark at the beginning of every number, the top number box in your slip. So T4, we're going to have check mark on the box 14. Our T4PS, we're going to take the top number with a dollar sign in front of it, put a check mark there. That'll be my box 30, my box 26 in my case, and my box 24. Okay, any other questions about this file before I go on? Marie, so for the CRA authorized, you get an error. That's going to be because of your settings. So what I'm going to recommend that you do is rewatch the recording for the very first TPS class that we did, because I showed a method of changing the settings there, or you can go back to your slides from that class and there are photos of how to do that. Because if you change your preferences, it will, so the preferences were in users defaults. There are some buttons that you can click in here that will make that warning go away for all of your files. Yeah, and I recommend doing that because you're going to need to have your warnings clear for your exam. So one thing we will be testing on the exam is what does your notes and diagnostics page look like? And it's going to have to show no warning symbols in it, and it's going to have to show only one bullet for the e-file error. Okay. If you're still not sure about it at the end of class, you can let me know and I'll walk you through it at the end of class as well. Okay, excellent questions. Let's go on to the next case. So this one was Doug, and I added in a little bit of extra information for Doug. I'm going to show you why I did it in a minute. So it would not have changed the return based on the information you were given, but if this had been an actual client, very likely would have changed the return. So I'm going to show you why that box is so important. All right, so we had Doug who was working as an office clerk, but then he lost his job, and then he collected EI, still didn't get another job, ended up on social assistance for 1 month, very briefly on social assistance, and then That should be it for slips, I think. So we have a T5007, a T4E, a small T4 from the old job, and a small T4 from the new job. Let's take a look at what I wanted you to look at. So in addition to adding in that box 14, because we're in Manitoba, we have to practice those, we're going to take a look at what happened for the email. So this was a case where, I'm going to flip back again, trying not to flip too much, but this is one that I forgot to mention. He had already signed up for my account. So I'm testing whether or not you know how to tell the computer that he had already signed up for my account so that he gets the right information on his forms. So if he has signed up for my account previously, there is a different set of data entry. You may have had to look that one up in the computer. We'll go over that together. Okay, a couple of line numbers that I wanted you to check at the end. He did get Canada Workers Benefit, so I do expect you to have at least thought about the possibility of a Canada Workers Benefit checklist. If you're going to give someone a refundable credit, make sure that they're entitled to it. And I wanted you to notice some things happening on the provincial forms, because this is a really good opportunity to take a look at your provincial forms. So let's do all of that together. We have Doug Nielsen here. In my T5007, I have a box 14 entered, 0.92. You won't get a warning about this. The computer will not remind you that in Manitoba you need to have this. What will happen if you don't have it is you will probably give your client a refund that they're not entitled to. And then you'll file a return, tell the client how much money they're getting, and then they're going to come back in 2 weeks and say, I didn't get it. What happened? So that's why I'm really going to stress this one. Everyone in any other province doesn't need to worry about this. We have to think about it. Every T5007 we get with a box 11, we need a box 14. All right. For your T4E, again, we're doing minimal data entry. We need a box 14, 15, and 22, plus a box 30. The box 30 is important because if there is a clawback, that box 30 will determine how much the clawback is for. For my T4s, again, straightforward, but you're going to notice you need some extra check marks to clear your warnings. Often when there's more than one T4, the two employers don't adjust for each other exactly correctly, or they may not even know about each other, and so you're going to have some CPP or possibly some EI boxes that you have to check. And then this is the data entry that we want. My account at CRA, already registered for online mail. That will tell the computer when you do send the return that he is still receiving online mail, which he has signed up for. So that's an important one to make sure you know. We're still waiting to see whether or not there's matching data on this, but it is important if you know that the client has signed up for online mail that you do notate that in our system so that when we file the return, the information matches what the CRA has. Right, taking a look at the return, we had a Schedule 6, so we should be doing a Schedule 6 checklist. If you want to know whether or not he qualifies, you can go through the information here. So who is eligible to claim? He has to have been resident for the whole year. He has to have earned working income. At the end of the year, he has to have been 19 or older. And then we go through and make sure he doesn't have a dependent or a spouse. In this case, he's claiming the basic. He's not claiming the disability amount. He had enough working income. He has to have over $3,000, and he did. And then he has to have low enough income to qualify for it. So we have his net income here, and make sure his net income is below the amount where he is no longer able to get it. And then we can make sure the calculations make sense. So this should have been a fairly straightforward Canada Workers Benefit checklist, but I recommend you do them every time you see a Canada Workers Benefit. All right, there's his Canada Workers Benefit. There's the CPP overpayment. I knew I was going to be getting one because I had to verify those box numbers. I had entered the box 16s, and the computer said those numbers don't look right to me. I double-checked them. They were correct. I put a check mark on them, and then I can go look at my Schedule 8 and see how much did he overpay. Does it make sense? And in this case, you did. I'm going to remind everyone, because he is already registered, he's not going to register again. That's very important. That can create some hiccups for your client if you're registering for something they're already registered for. And I wanted to take a look at some Manitoba things. So we haven't seen a lot of family tax benefits, but I want you to notice even though he is single, his income was low enough that he is getting a little bit of family tax benefit. It's a good idea when you're reviewing your return to review your provincial forms as well. All right, now I promised I would explain why that box 92 is so important, or box 14.92 is so important. So in real life, if this was Doug and he was a renter, which he might have been, he's single, he's working some small jobs, he was on EF part of the year, he might be renting somewhere, he would be applying for the rent credit. I'm going to teach you the data entry for this later, but I want you to see what happens if I put the rent credit in now. So I'm going to add it in. Now, to make my life easier, I'm going to make sure I have a second copy. So what I'm doing now is something I will teach you in our last class, but I can make a copy where I can make changes on it without changing what I'm actually going to send to the CRA. So I'll be teaching you how to do this so that we can see what it looks like if you have a client who says, what would happen if? What would happen if I had put an RSP in? What would happen if? I can make those changes without changing the return that I'm going to file. So I'm going to give him a nice amount of income. I will fill this in correctly in real life. I'm not going to fill it in completely now. But what we would have had in this scenario is we would have some Manitoba credits, which he doesn't get. Personal tax credit, his income is too high to qualify for it. Then we would get some rent credits. Rent credits here, he is limited to $525. If I had not put in my box 14, he would get $525 because I told the computer that he's entitled to it. However, that box 14 comes into play further down on the form. And if you have been doing this with your fillable forms, you will remember that if you receive the T5007 from Manitoba, then your box 14 is 0 if there's no fraction in it, in which case if you multiplied 525 by 0, he would get 0 of this credit. So that's what would happen if he was on social assistance for the whole year. Because he was only on social assistance for 1 month, he has to have that credit prorated by the 1 month. And again, we don't determine that. The social assistance people determine how much he gets. But in this case, he would have been entitled to 92% of his credit. And that would limit it to 483. That's why that box number is so important. If I had forgotten that box number, I would give him more than he was entitled to. And again, he would come back and say, well, you told me I was going to get this much, and that's not what I got. Why didn't I get that? The worst scenario are if you're doing a client who was on social assistance for the whole year, and you don't enter that 0, the default will be 1. And because the default will be 1, they will get their full provincial credits, even though they're not entitled to them. Well, they won't get them. You'll tell them they're going to get them. And then the CRA will know that they had a box 14 and will not give it to them. So there we go. That's how that works. I will be teaching you this rent credit data relatively soon. I want to get through the tricky things we're doing today. So in this scenario, if he had had rent, he would have gotten a prorated rent credit in addition to everything else, and then he would have a refund. Because he didn't get rent, I'm going to go back, and his actual refund is $833. The last thing I need to do, we've talked about check marks already. I want to talk about why he has a refund. Can you give me your notes. Let me know which notes you put down. Pull up that comparative summary again. And at this point, we're going to be looking at deductions, and we're going to be looking at credits and refundable credits. So what did you put for the reason that he is getting a refund over $500? Canada Workers Benefit, absolutely. And one more thing. So Manitoba Family Tax Benefit is part of it. It is a teeny tiny part of it. I am going to say for the notes in real life, we will put provincial notes in. For practice in this course, we're not going to put provincial notes in because we can't mark consistently across the provinces, so we're going to do just federal things, but in real life, yes, you should be thinking about Manitoba things. But Helene, CPP overpayment is the other one that I was looking for. So I'm never going to say don't put a note in, but I am going to tell you we're not going to be testing you on provincial notes. So I had to, CPP overpayment, Canada Workers Benefit. Good. What advice would you give this client for next year? Is his return going to look anything like this year next year? Nope. Hopefully that new job is going to be a permanent job and he'll have just a T4, in which case, if all he has is a T4, you need to remind him, probably not going to get a big refund next year if that's the only thing you're doing. Maybe you could talk about some other things he's expecting to have. Is he working from home? Is that still going to be a thing next year? We don't know if it's going to be a thing next year, but you might have that conversation. What are some records he might keep? Does he donate? What receipts can he keep for next year? But mostly you're going to let him know this was a difficult year. Rent, exactly, if he's renting and he hasn't claimed a rent credit before, find out some information about that. What receipts could he bring? What's going to look different next year? And then have the conversation and say, look, this year was a really rough year for you. Next year should be a really normal tax year. So whatever a normal tax year looked like for you in the past, that's probably what's going to happen. And then you can tell him if he's worried about it for next year, he can always come in early, come in February before that deadline and take a look at what you're going to have. Or, you know, we give clients to advice year round. We are available year round. If he gets to the end of the year and it's, you know, October, November, this time of year, and he says, I have no idea what my tax return is going to look like, and I'm really stressing about it, sit down and have a chat with us. We'll talk about it. We'll say, what did you have for income? Where are you on track? What have you done? Have you done any of these other things, donations, whatever it is? We can give him at least a picture if he's nervous about it. Most clients don't think about it. They don't worry about it till tax time and they come in. But it's always good to let them know that that is an option. All right, good. Excellent work on that one. Let's take a look at the next file that we have. The next file we have is Reginald Morrison. We had Ingrid and Reginald. Ingrid doesn't want to file a tax return. We're going to give her some advice. So I had some questions for you on that one. We're going to get to those. If you haven't thought of those questions yet, we will talk about it. I'm going to open up my Reginald and Ingrid file here. And I want you to notice I have created two files. Why did I create two files? She had slips. That doesn't always mean I need two files, but it definitely helps. I could have calculated her net income in my head. It's the dividend transfer. I had a feeling there was going to be a transfer. She is low income and she has dividend income. I would like to be able to do the dividend transfer. I don't want to have to do it manually. That's a huge pain. So because there's something I want to transfer between the spouses, I should create two of them. So I have created two files. I have one for Reginald and I have one for Ingrid. Reginald, very straightforward. He has a T4. Excellent. Ingrid had a little bit more. So Ingrid, first thing I want to point out for your infirmity, I know from seeing some students practicing that this infirmity disability data entry is still causing some confusion. You have to learn what the defaults are in your computer and then take advantage of those defaults. So whenever you put a line on the tax return, go to the tax return itself and see what it did. If I had just said infirmity, I'm going to do this, I'll put it back in a minute. If I just said she has an infirmity, I think that means that I've told the computer that she is infirm. What I've actually told the computer is that she has a disability certificate on file with the CRA. The default position is she has a disability certificate that has been approved. I would know that if I went to the tax return and I went and looked at her forms and I looked for disability amount and I found out it's giving her a disability amount. That means the computer thinks that she has a disability certificate on file. I have to tell the computer that she doesn't. So that's what I mean when I say if you do data entry, go look at the tax return and see, did it do what you wanted? Because this is not what I wanted. What I wanted was to give Reginald a caregiver amount only. So now I'm going to go in here and I'm going to say, how do I change the default? The default is to use it. I'm going to tell it, don't use it. Minimum data entry, you're going to notice I have not ticked off caregiver because I don't want to tick off caregiver. If the computer will give it to me without me doing any data entry, I'm going to let it do that. So if I go to the tax return, I can see that the disability amount is gone. I didn't want there to be one. And then I'm going to go in here, and I'm going to go to my Schedule 5, and I'm going to see, did I get a caregiver amount? And I did. So I don't have to do any extra data entry. This is your time to practice. What is the difference of not infirm? Good question. Not infirm is something we are never going to use. So not infirm means I shouldn't have done any data entry at all. So that would say she has not a disability and not an infirmity. She has nothing, which I could do just as easily by doing this. And that is the equivalent of not infirm. So again, some of this data entry is in there because in old years there was a reason why we had an extra piece of data entry, but it isn't really relevant, or you've put something in and you want to take it out. You used that but got the right answer. In that case, I'm not sure, but I would say don't use not infirm. So what I would do, just generally speaking, is tell the computer precisely what it is that you want. So again, I don't know what the initial intention of not infirm is. I wonder if it's in the help file. I will see if it's in the help file. Nope, it's not going to give me any additional information. So there may have been a reason why it did that, but she is infirm. So we don't want to have in our computer the fact that she is not infirm. We want the computer to know that she is infirm, which means we can get a doctor's letter, but she doesn't have a disability certificate on file. So this is the correct data entry. All right, other things that she had some babysitting income, casual labor for her, and she had some tax slips. We had a T3. You should have had just the box 49 entered, other income and capital gains, check mark for your data entry. T5 Canada Savings Bond, check mark for your data entry. T5 Scotia Trust, check mark for your data entry. And we have generated a tax return for Ingrid. We do not need to file a tax return for Ingrid. Or do we? We're going to come back to that question. She doesn't want to file a tax return. Let's take a look at her income. I have entered in other employment income. There it is. I've entered in investment income. I've entered in taxable capital gains. I've entered in dividends. What happened to the dividends? I put the data entry in. Where did the dividends go? They got transferred to Richard, and I didn't have to tell the computer to do anything. The computer said, high income spouse, low income spouse, it's going to increase the spousal amount. I will do that for you because we joined the files. So that's where if you had tried to do this with a single file, you would have had to have done all those adjustments in your head and have remembered the disability amount and have done all those adjustments. It is much too much work to do that. You are likely to make a mistake. So we're going to allow that to happen. There's the dividends. The benefit of that is that he's going to get a larger spousal amount and he's going to get the dividend tax credit as well. So even though he's the higher income earner and therefore he might be in a higher tax bracket, it is still beneficial for him to have the dividend income added for those two reasons. We've increased the spousal amount and we've also given him a dividend tax credit. Good. All right, other things that he had RPP, he had union dues. He had that spousal amount, which is now higher because we took the dividend income away from Ingrid. What else did I want to look at? We're going to talk about notes for Reginald. We don't need notes for Ingrid because Ingrid isn't getting a refund over $500 for sure. Okay. So let's talk about the notes for Richard first. What did you do to explain his refund? He has a nice big refund, $2,676 rounded up. What is your explanation? I can think of 4 things off the top of my head. Okay, dividends. Dividend tax credit, we want to say, because dividend income would be the opposite, but if you say dividend tax credit, I'll give you that. Registered pension plan, yes. Dues, yes. He has a dependent spouse and a caregiver amount for the spouse. Excellent. So RPP, union dues, spousal amount, caregiver for spouse, and dividend tax credit. I am going to say be very careful, just generally speaking. If you're using a shortcut for something that could be either income or a credit, make sure you specify which one it is. So if I said interest, I would need to say interest expense as opposed to interest income, because interest income doesn't make sense. So as short form as you can to make your life easy, while understanding that someone else might be the person reading this who's going to have to figure out what you meant. There are some acronyms that we get really comfortable with, like CAI for climate action instead of CWB for Canada Workers Benefit is the word that I was looking for. I know the acronym better than the actual terms, RPP, things like that. But then if you say dividend, I need to know, do you mean income or do you mean tax credit? So those little details. Excellent. Good. Let's talk about Ingrid. I'm going to go here, and then I'm going to say Ingrid doesn't want to file a tax return. What advice should you give Ingrid in this year? She's not getting a refund. There won't be any benefits that she needs to file a return to apply for. Is there a reason why she might be required to file a tax return this year? Again, if you're not sure, you can go back to Chapter 1, our section on who has to file tax returns. And Helene, yes, technically the capital gains requires her to file a tax return. It doesn't necessarily mean we're going to file one for her. It is her choice, but we need to explain to her that it is technically a requirement. The problem with that is there is a risk of not filing, that there could be a penalty for not filing. Now, how much the penalty would be for not filing $40 of capital gains, taxable capital gains, is that a huge risk? Probably not. But we do need to make sure we're explaining to our client her obligations. So the correct answer is she is required to file a return this year under the rules. She may, however, elect not to and just see if the CRA cares one way or the other. There's a higher chance they're going to want her to file because the dividend transfer happened. They may be looking into those returns anyway because there is a tax slip with dividend income in her name that is being put on his. If they open up that return to take a look at his, they may want to see her corresponding one to make sure that it was eligible to be transferred. They're going to want to confirm her income, in which case they may ask her to file anyway. Again, do I think they're going to issue a really big penalty for not reporting $40 of dividend income? Probably not. But the client should know what the correct answer is, and then they are the person to make the decision. So if she said, you know what, if that's technically what I'm supposed to do, I want to do it. It's important to me to do what I'm supposed to do. We'll file that return for her. If they say, you know what, it's $40, I'm willing to take the risk. And if they ask me to file, I'll file later. because I don't think the penalty is going to be very big, we have the option in that case of closing the file. You might put a few more notes in that circumstance to say why file closed, client elected not to file, and then I would put some additional notes in there. We explained that she is technically required to file because of the capital gains. Penalties were not likely to be very high, if any at all, so the client has chosen not to file unless she's asked to do so. So that was the tricky question here. Remembering that sometimes even if you think you don't need to file, the client has no idea. She thinks if you owe money, you have to file. If you're getting a refund, you have to file. If you have capital gains, you have to file. How do we ensure it doesn't get filed? We just don't file it. So the first thing that I would do is you won't have anything signed. If you have nothing signed, that file will not get filed. But again, if I want to make sure it's in an office and I'm thinking someone's going to come in and be like, oh, I should have sent that, I will tell you we don't do that. I will never e-file a return unless I have the signed page in front of me saying sign it, that's signed, I can file it. But we can close it. So I would go into the client list where Ingrid is. I would go into my information. I would say file closed, client elected not to file. I would say okay, and then it would say file closed. So then if we're going in and we're going which ones are filed, which ones aren't filed, it's not going to be on my list of why didn't we file this. We have a way of closing the file to say we're not expecting to file this one. Okay. Now, if you were wondering, is it possible to get the same answer using related party spouse not processed? Technically, yes. It is possible. I wouldn't do it, but you could if you wanted to. You have to do all of the adjustments manually. You would have to enter the dividend portion of the tax slip on his return. And like I said, it is a real headache, and you are likely to miss something. I am likely to miss something. I wouldn't do it. Okay, good. Any more questions about this one? Okay. Even if you're not filing a return, I am going to say if you are creating data for someone, you should be doing quality at source for that person. So Ingrid had tax slips. Ingrid had check marks. We will mark you on your quality at source. Okay. And it's snowing outside. Very nice. Let's do a few more. We have Joseph and Jane. Joseph Simon and Jane Simon. Okay, I asked a whole bunch of questions there. And we did some quality at source and some notes for both of them. I'm going to take a look at the file in this case. That's Reginald and Ingrid. Here we have Joseph and Jane. They have a son. So we need to create 3 people because we want to make sure we have a son. Okay. Joseph and Jane were both employed during the year, but Jane works part-time. We had RSP deductions limits and undeducted contributions, and they each made contributions this year, so we have to make sure we have those. We had a number of expenses, so we had medical expenses, and we had some donations, and the client has given us instructions as to where they want that to go. Remember, it's their return. If they want to do something that is not optimal, it's their return. As long as it's allowed, they can do that. So if the CRA says either person can claim the medical expenses, and she has a person who wants to claim them, then we're going to do that. Now, if it's not in her best interest, I would explain to her why I don't recommend it. But if she says that's what I want, that's what she wants. I will say, however, try not to do extra data entry. So what I would do in this scenario is I would do the returns first, then I would look to see where the computer put things. And if it put things where she wanted it to be, great. I don't need to do anything. If it put it where she doesn't want it to be, then I have to step in and do an optimize or a transfer depending on what type of credit that I'm looking at. All right, so we're going to put all our data in, and then we're going to see what it does in the computer. And if it doesn't do what we want, we're going to fix it. All right, we have some T4s, one for each of them, and that's it. So my first question was, on whose data entry did you enter the medical expenses, and on whose data entry did you enter the donation? Okay, so I have a few people who put the medications on Jane and the donations on Joe. I will show you what I did. I put everything on Jane. Only because, and again, this comes more from a years and years of experience, she's the one who made the donations. So if she loses those receipts and she needs to get copies of those receipts, I know who to ask and say, oh, foster parent plan, Jane, you donated the foster parent plan. Can you contact the foster parent plan and get a copy of that receipt? If I ask Joe, the foster parent plan isn't going to know who Joe is because Joe didn't make a donation. So they're not going to give him a copy of his receipt. So sometimes we're going to use the computer to help us after the fact as well. I always enter things on the person who did it. Now, if it's a joint one, if both of their names are on it, put it on the family head if that's convenient for you. But generally speaking, best practices is the person whose name is on the receipt is the person who should have the data entry. Okay, so it's not wrong, but it's not best. So best practices, if Jane made the donation, put it on Jane. And again, does it make a difference? Well, we'll find out. I want you to notice, I have done medical expenses on Jane. I have done donations on Jane. I have not done any optimizing or transferring on Jane's file. I show you Joseph's file, and you can see I have not done any optimizing or transferring on, oh, what was his name again? Joe's file. But when I go to the tax return, it put the donations on his anyway. Because I made him the family head, and the default is the family head gets the donations if they can use them. So the computer will say, who can use donations? Give it to the person who can use it. If both of them can use it, they'll give it to the family head. That's the default. I don't have to do anything. I don't have to enter it on his. I put it on hers. The computer will give it to him unless I say otherwise. Good. Medical. Where did medical go? Well, it went on hers. I didn't do anything. The computer knows that it should go on the lower income person if they can use it, and if they can't use it, it will put it on the higher income person. It knows the rules better than you do. It knows the rules better than I do. It applies the rules in every scenario unless we tell it to do otherwise. So in this case, Jane is getting precisely what she wants, and I didn't have to do any extra work. All right. Which medical expenses do we have? Where did these medical expenses come from? So I entered these on Jane's data entry. We had vision center glasses. We had Dr. White Dental. And I will see if we had anything else. And we had medical premiums. If you missed the medical premiums, they were on Joe's T4 box 85. If you didn't enter that, the computer probably didn't give medical to anyone because they didn't have enough to use. Yep. So if you missed that, that's one box. Go put that box in, and you'll probably get the right answer. And again, I'd like you to do the same thing that I'm doing, which is when you're double checking your returns, take a look at your return. I went into her page 6. I wanted to see what number I got for this. If you double click on that number, it's going to take you to your summary. Or if you go down to medical expenses on the left-hand side, I can do a summary of what donations have they claimed. So they had donations for the foster parent plan and a tax slip donation. Hopefully you didn't miss the box 46. There's a box 46. And I can look at medical and see where did the medical come from as well. Then you can go back to your actual case and say all the things that I circled, just like when you did them on paper, circle every number that you think should end up somewhere. Double check your tax slip. So tax slip has a box 46, it has a box 85. I can confirm that what I have done is what's on the return. Okay. Talk about the RSPs really quickly. So I'm going to look at Joe's first. So for Joseph, if you have done your data entry correctly, your Schedule 7 will have undeducted contributions here. Don't have to worry about a T1 OBP in this case. He's well under his limit. So he had, well, not well, he has a small limit, but he's under his limit, and there's a $2,000 buffer. So in either event, an extra $458 undeducted is okay. But it's there, so I want to know that I can use it. He has made 2,000 contributions. He doesn't have any repayments he needs to make. We're going to use all of it this year unless he says otherwise or it's a bad idea. In this case, it's a good idea to use all of it. I am going to warn him, however, he is pretty close to that limit. That limit will go up next year, but you want to make sure whenever you have a client who has a very low RSP room that they're aware of the number they should not be going over. So that is a conversation that I would be having with Joe. And then for Jane, hers will look very similar, but she did not have undeducted contributions. She just had a $2,000 contribution. She had a larger limit than he did. She's going to use all of it this year as well, and there will be no carry forward for her. Again, $8,000 limit. She's making $2,000 contribution a year. If that's a pattern or a history, I'm not going to worry about it. But if she has a history of fluctuating RSPs and she's getting close to her limit, I'm going to have that conversation with her before they leave. All right. Good. You should have had lots of check marks and some notes. Let's talk about the notes. What were your notes for Joe? So 4 notes for Joe, 2 notes for Jane. What did we say for Joe? RPP, RSP, union dues, and donations. Excellent. Yep, that's what I put too. For Jane, what did we have for notes? Only 2. RSP deduction and medical expenses. Perfect. Really, really, really good. So that's what our notes will look like. We've got our check marks for getting really good at this, I think. Okay. That's our practice problems. Are there any questions about what we've done up till now? Anything you want to review for your data entry, best practices, all of those things? If not, we're going to jump into the next chapter, and then I'm going to do one issue first. We're just going to introduce one idea. We're going to take a break. Oh, for the medical premium, yes. No, medical premium, sorry, I should clarify. The expenses will go on James, but the premium was paid by Joe. And it is family premiums, and it's on his T4. So because it's on his T4, it has to stay on his T4. So you do the T4 entry as the T4 is, and then receipts will go for each person for whom the cost was. So T4s stay on the T4. Receipts, you have to decide where to enter them. You enter receipts based on who received the services. Oh, my last question on the file was about the son. Yes, thank you. I forgot. Extra things that I wanted you to think about. Based on Jason's age, what other questions would you ask the parents to maximize their tax returns for 2022? So how old was their son? Born in 2011? Absolutely, I might be asking them about childcare. What else? We're in Manitoba. Fitness amount, arts amount, what activities is he in? If he is in other additional activities that don't qualify as childcare, he might still get some additional credits that we can give to one of the parents to reduce those provincial taxes. So definitely I would be asking about those for a 10, 11-year-old. Probably he's doing something. Might be tutoring, might be an after-school program that's supplementary to the school. So it might be a drama class. all kinds of things he could be involved in that are costing them money that we can give them credit for. So there's our sport, recreational, artistical. I will teach you the data entry for that in probably next class when we get to childcare. I'll teach that. Richard's file. Lillian Richards. Which Richards file do we want? Oh, Morrison. Reginald. So the T4 for Reginald has box 14, 16, 18, 20, 52, box 22, and union dues. Simon. Oh, I will say, I should explain, there was a little bit of a hiccup in, yep, too many names. There was a little bit of a hiccup in the computer. So what I have to explain has happened here. When I gave you the original practice problem, because we are the first class that started, I was using the tax slip that was in the textbook at the time. Unfortunately, there was a typo in one of the answer keys. And so what has happened in the Simon's file, which I will pull in here, is you're going to notice that it now says box 16 is 2511.3. But when I first did it and when I gave you your answers, it said 0.63. And I know that it did that because I'm the one who caught the problem. But you'll notice at the beginning of your textbook, there is corrections, and they have changed the box number. So yes, if you got the answer that I got, you did it before they changed it. If you got a couple of cents difference, you did it after they changed the tax slip, and they did it right in the week when we were working on it. So both answers are correct depending on which version of the T4 you were looking at. So I will give you the updated one. So what I had done originally for Joseph Simon was, where is it? It was 1070.95. But if we change it to the new figure, you can see how that typo happened. Instead of typing 63, they just typed 3 and press tab. So this is why we double check our numbers. It's 0.86. If you got 1070.86, you did it correctly. Okay, I may send out a updating email with that information for everybody. I'm going to put it back to what I had originally done, but I will make sure that I have a note for myself in that file as well for review. Yeah, very good question. If that comes up again, send me an email and be like, I'm off by a few cents and I can't figure it out, and I will get back to you. But I will also say you can always check in the clarifications and corrections, they have a date. So if I gave you an answer that is before that change and you now have an answer after that change, that probably is what's going on. All right, and I apologize. These should be checked ahead of time. All right, let's jump into our next chapter. I'm going to give you some information about Robert and Margaret as we go. Hopefully you've already entered in their personal information. Hopefully I've entered in their personal information. I have. So I've only entered in, you're going to see I have no slips here. We have Robert and we have Margaret, just their personal information. And what I'm going to start to do is give you some information about them as a family as we go. Today we're dealing with seniors income, but that also means because we're talking about RSP income, we're going to deal with some of the other difficult RSP things. We're going to talk about transfers, and we're going to talk about early spousal withdrawal as well. That'll be later on in the class, so if you haven't brushed up on that, you can do that over the break. I'm going to start with a little bit of an explanation. This is something we do see more commonly with seniors, but not entirely with seniors. Sometimes people are not able to come in and file their own tax return. Sometimes they will give a power of attorney to their spouse or to one of their children, who will then file their taxes on their behalf. So the first thing that I want to do today is talk about what we do if we're going to enter a power of attorney for someone. So let's assume in this case that Margaret is going to be out of town visiting her sister in the United States for a period of time and will therefore not be able to come in person to file her tax return. So you can have a power of attorney that is permanent, that says because this person is not able to look after themselves, they have someone else permanently in place. You can also have what's called a limited power of attorney, which is I will designate the dates, and between these dates, this person can act on my behalf, but outside of those dates, they can't. So that's what she's done in this case. She's leaving town. She knows she's going to be out of town for, let's say, 2 months. So for those 2 months, she's going to give a power of attorney to her husband, Robert. So that way he can file his return. He can also file her return. Okay. When we have a power of attorney, we need to tell the computer that there is a power of attorney. How much we do in that scenario depends a little bit on the circumstances. So in this case, if we're going to add a power of attorney, I recommend we go into our Smart Start client profile. And you're going to pick 2 things in most cases. So almost every time you're doing power of attorney, you're going to choose other personal data and guardian or legal representative. Those are the 2 boxes on your Smart Start that you want to enter. Okay. If I say continue here, guardian and legal representative, you're going to tell the computer that she has a guardian or legal representative. She is not the person who's going to sign things, somebody else is. You're going to say yes. It's going to open up a whole big box. The next thing it does is it's going to have some red stars. So now I have to fill in the name of the guardian or legal rep. If it is Marshall and it is Robert, that is what I'm going to put in. I don't need to put any other information in here unless I'm keeping that for my own personal use. So in some circumstances, you will have a power of attorney who will have the right to do things, but they want to keep the mailing address as maybe if it's an adult child, they want the mailing address to the return still to go to their parents' address because they don't want it coming to their house. In that case, if I want to know how to contact them by mail, I might put theirs in. More commonly, we will change the street address and the mailing address and the phone number to the name of the power of attorney, especially if it is a permanent power of attorney. So if you have someone where that's the person who's going to deal with that tax return indefinitely for all time until they change it, then we want that person as the person we're contacting. So if we're changing the street, we also want to tell the CRA that there is a power of attorney. So in every circumstance, once you do legal representative, you also want to notify the CRA that this return is being sent to a person who is not the taxpayer. So you need to enter something on the care of line. So we're going to put Robert Marshall in here. Okay. So that does 2 things. The legal representative here is going to update information for the CRA and tell the CRA for all of the forms who is signing the forms. This is going to tell the CRA as soon as they look at the tax return on the very first page that this return is being given to someone who isn't the taxpayer. There's one more thing we do for power of attorney, which you should do in every circumstance, which is representative title. You want to tell the CRA what type of authority they have, what type of legal representative are they. When you do the drop-down box, the most common ones are executor, administrator, liquidator, or trustee. So executor, administrator, and trustee are all things you would use after someone has died. So these are things that arise because of someone having a will, or if someone didn't have a will and they went to court to be appointed an administrator. They might be the trustee, they might own a trust, in which case, or they might be administering an estate. They would be a trustee in that case. A liquidator is someone who is representing someone because of bankruptcy. All of those scenarios are outside the scope of this course, so you're not going to use any of those. What you're going to do is other, and you're going to say power of attorney, or if you don't know how to spell power of attorney because it's a horrible word to spell, just say POA, because POA means power of attorney. That's going to update everything on the form. So what I can show you, and I'm going to do a little extra data entry here just to show you what the forms would look like. So I'm going to say yes, even if ineligible. And I'm also going to do an authorization for Margaret come back and talk about that in a minute. But if I've done those when I'm generating the forms now, what I'll see on the return right up at the top, care of Robert Marshall, that tells the CRA this is a power of attorney. They will not process that return until they have seen the power of attorney document themselves. This will put a hold on the processing of the return if this is the first time that the power of attorney is being registered. If this is a power of attorney that is a long-term one and the CRA already has it on file, this isn't going to slow anything down. But if it's the first time, it's going to put a delay. They will not process the return until they have read the power of attorney and agreed that this person has authorization. You have to include every page of the power of attorney. Every page has to be in order, and the signature on the end has to be witnessed by a lawyer or a notary. And so if you do have this in an office and you're not comfortable with these documents, find a more senior associate who can take a look at it, review it, and make sure everything is there. If everything is there, we will then scan it to our computer and we will upload it to the CRA. So through Represent a Client, we can immediately send the power of attorney documents connected to that client. If we have authorization for Margaret, we can do that right away. So care of is the first thing that must be there. The next things that I'm going to show you, you won't have access to, but in an office you will. You're going to notice the filing return. This is the thing that says, please file my return electronically. We need a signature before we e-file. It has Margaret's name on the top, but you're going to notice down at the bottom, it's going to say Robert Marshall, POA, power of attorney. It's going to say this is his title. So then, again, when the government gets that form, if they ask to see that form, it will identify it as power of attorney. If Margaret was a longtime client of ours, we will have access. We will have CRA authorization already. We do not need to do a new one if we don't want to. I will tell you, as my own practice, I usually generate one that I don't send, but I have a signature in case I need it. But until Margaret takes it away, she has the right for us to continue to represent her. So if she was a longtime client, we would not need to do anything. If she was a new client, however, we would need access to represent a client so we could do autofill my return and all of those things. So we would have to generate an authorization form. And again, we need to make sure that it's her name at the top of the form, but the person signing it is her legal representative. So Robert will be the person signing it. His name has to be on the form. The form that is electronically sent has to match the form that they've signed. So we can't generate one for Margaret, pencil in Robert Marshall, and get him to sign it. The computer has to have Robert Marshall because that's what we're sending to the CRA. So that legal representative data entry will do this for you as well. Are there any questions about this? So again, authorize my return. We do, if they are new and we don't already have authorization, we will do a new one for them. It will take time to process. Unfortunately, the CRA will not verify this authorization until they've read the power of attorney, which we're going to scan and send to them, but it's not going to happen overnight. So sometimes we have to do returns without autofill my return and without checking represent a client because we can't get access to it right away. Hopefully, if it's a long-time power of attorney, they're already on file, we have representation, we don't need to do anything extra. Or if they're a long-time client and they've previously authorized us, we don't need to do anything extra. But if they're a new client, we need to do the authorization form as well. All right. There's always a question that you have to ask is whose address you're going to put. In this case, let's say instead of giving power of attorney to Robert, Margaret decided to give power of attorney to her daughter, and I'm going to say Emily Smith, because her daughter is married to someone named Smith. It's a very common name. And she wants it to go to a different address. So I'm going to say Smith, and I'm going to say Emily here. I can't just put the address in here and have it go to that place. I need to enter an address for the tax return, but you're going to notice I don't have an address field at this point because she's married, so we have to create one. And for that, you can use the keyword street, and then it will open up the mailing address, and you can put Emily Smith's mailing address in here, I'm going to say 1 New Address Road in Winnipeg and Manitoba, R3, 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 why not? Wherever that is. And now I'm going to get an enter address only if different from family head warning, which I have to clear and say, yes, it is different than the family head. That is what I wanted it to be. So I can put a check mark on the street line to say I did mean to do that. And now when I go in here, I'm going to have on the first page, Margaret Marshall's return care of her daughter at a different address. And then Robert can have his return go to him personally at his address. So that's how we would do the data entry for that. I'm going to take that out because that's not what we want. So I'm going to go back into Margaret and I'm going to say, take this out, and I'm going to make this Robert, and I'm going to make this Robert, and I can leave everything as it is. Okay. Are there any questions about power of attorney, legal representatives? All of this is in your textbook, so you can refer to it. This is not data entry I necessarily expect you to memorize. It is important you remember that care of line. So that's critical if you can make some notes for yourself on that. You can't just do the legal rep. You have to do the data entry in 2 places. Okay. If you think that's really frustrating and annoying, you should have seen how it was a couple of years ago when I started taking this course. We had to do the data entry in 4 separate places in order to get the legal representative everywhere it needed to go. They have streamlined it somewhat. There's just this one more line that is not automatic. We have to do that extra line. All right, let's take a break there. It's 10:12. We're going to take a break until, I'm going to say 10:18. When we come back, we're going to jump into some of the seniors' income that we're going to deal with. Welcome back from break. Let's see where everybody is. Give me a check mark if you are back from break. Okay, we've got 1 person, 2 people. All right, 2 people is enough people to keep going. Let's do that. So we have talked about legal rep, generally speaking. Again, just a quick refresher on that. When you're doing legal rep, you have to think about who is going to be receiving the mail. Who do you want to give the mail related to the tax return to? If the answer is the legal rep, change the street address so that page 1 of the tax return goes to that person. If you want it going to the house where the person lives, that can be an option, in which case you're going to leave it the same. I will say 90% of the time we are changing the address to the address of the legal rep instead. Okay. Care of is irrelevant to that question. Care of must be on page 1 if there's legal rep because it tells the CRA that somebody else is going to be signing that return. So you have to have the care of line and you have to have a legal rep data entry done. But we have solved our personal information. So we have set up the files. Now we're going to start talking about seniors' income for Robert and Margaret. As always, I'm not going to do this in order, and I am going to be adding and taking away additional information. So let's start with taking a look at what we have here. We have lots and lots of different tax slips, which are the sorts of tax slips we expect to see when we're dealing with seniors, people who have retired or are in the process of retiring. And we're going to start with the very, very first one for each of them, which is our T4A OAS. So they have old age security. Each one you can see in this case is collecting the maximum, and we're going to demonstrate the data entry for that one. As always, if it's not a T4 and it's a tax slip, we're going to go into our tax slip information, our T-slip information. And make sure, again, it's a T4A, but it's a special type of T4A. So we have lots of different T4A options. We're going to choose T4A OAS in this case. If you pick the wrong one, the data entry will not work. Because it's old age security, I don't need to put a name in. They're all coming from the same place, so it's not really relevant. But I do need to put in a box number. I'm just going to change the sizing of my screens a little bit here so you can see what I'm doing. I have a box 18. I'm going to fill in the box 18. There are other boxes that might be on a T4A that we would need to enter. So if they had repaid some overpayment during the year, if that repayment has already happened, they will have a box 20, in which case you'll enter a box 20. If they're receiving GIS, if they have guaranteed income supplement, they will have some additional information there. So that would be a supplement in box 21. That would automatically put the guaranteed income supplement on the tax return total income line and would deduct it because it is not taxable. The computer would do that for you if you've entered the box correctly. Some people have tax withheld from old age security. If they've had tax withheld and they have a box 22, you'll enter it there. That's one that can be easy to miss. So I will say when you're dealing with taxpayers who are retired, they're receiving OAS, but they have a little bit more money, make sure you're checking for that box 22 so we don't not credit them for tax withheld that they have paid. Remember, the CRA will not necessarily automatically adjust that for them. They will adjust income, they won't adjust tax withheld. So just check out for those box 22s. Often our clients don't have any tax withheld from OAS, but every now and again they do. All right, that's all you need for that one. As always with a tax slip, double check your number, and if your number is correct, put a check mark on it. If you've done that for Robert, I'm going to ask you to then flip to Margaret's file and do the same thing on Margaret because she also had a box 18. And just a reminder, there's lots of different ways of switching between files. If I'm in data entry, I like to do it this way. I go to select family member, which is this one up here, go to Margaret, say OK. Now I'm in her file. And I can go into my tax slip, and I can say T4A OAS again. I have a box 18, 7486.71, and double check that number. If I've typed it correctly, do my quality of source double check. What we're going to do next is we're going to make sure it went on the tax return where we wanted it to go on the tax return. So here, I'm going to go into my income page, and you're going to see I have a line 11300. If we had had, again, guaranteed income supplement, we would have down at the bottom, box 21 of the T4 IOS would go here, and then it would come off again at the end here. So you want to make sure you're thinking about that. If their income is really high, what might happen? So if I've entered old age security income, but their income is really high, what do we have to worry about? Clawback. Again, the computer will automatically calculate a clawback if there is a clawback. So if the income is high enough, you don't have to do any extra data entry, but you do need to be able to explain the data entry. So if there is a clawback and you weren't expecting to see one, you should be verifying the other income figures on the return and making sure you haven't made a mistake there. Or if you weren't expecting one because it was really close to the border, when you go in and you take a look at it, you should double check and go, does that make sense? Oh, yes, they did have a little bit more than this, so that's why I had a clawback. And then you can explain to your client what the effect of the clawback is. So remember, when you get OAS clawed back, what happens next year? In this case, there isn't a clawback, but if there had been one, what would happen to the old age security next year? This happened to a lot of clients who were on old age security and then they received the CERB benefits, which they shouldn't have. It will be reduced, right? So if that had happened to your client, if they were receiving CERB benefits, it bumped them up to where they were getting a clawback of their old age security. Next year, they don't get the CERB benefits because they weren't supposed to get them in the first place, and also CERB doesn't exist anymore. They're also going to have a lower OAS income until that gets adjusted in the future. So that's important to make sure your clients are aware of if there is a clawback. Good. So the computer will do most of the work for the T4A OAS slip for you, but explaining what it did is still your job. That's the first data entry that we're going to do. We're going to go back to Robert now and split screen again. I'm going to talk about the next really, really common slip that we have, which is your CPP income. So CPP income isn't always paid out to people who are retired. You might be receiving a survivor benefit. You might be receiving a child benefit because of a parent who died. You might be receiving disability, or it might be regular retirement. They're all going to be handled in the same way. So if your client has a T4AP and their name is on it, then you're going to enter it. With one exception, sometimes the child benefit will have the name of the parent, but it is actually for the child. That tax slip should be entered on the child's data entry because it is their income. So that's the only one you have to watch out for. Other than that, generally the name on the slip is the person who's receiving the income. Oh, I would say with one other, which is the death benefit. If you see a CPP death benefit, go get a specialist because it has to be handled differently. Okay, so CPP death benefit means someone died recently. Go find someone to help with that. But those two scenarios are the only complicated ones. Everything else, CPP, is fairly straightforward. Again, it is a special type of T4A slip, so make sure you choose T4AP. Don't need a name in this case because it's coming from the Canada Pension Plan Department. We do, however, need to enter box 20. The problem with box 20 is that box 20 is actually a summary of a number of boxes. So that's why we have a drop-down box. You're going to need to identify what type of box it is. So for this, I'm going to demonstrate first, and then we're going to do the data entry. Depending on which box we pick, we're going to have different information. So if it was CPP disability, I would choose box 16. I would enter the box 16 amount, whatever it was, and then it's going to say how many months were they on CPP disability. And it's going to have a red star, and I can't do anything until I fill in that red star. On the other hand, if it was a child benefit, I'm going to have to delete this to make this work for me. If it was a child benefit, I would put a child benefit in, and you're going to notice I'm not going to get a box with red star because it has nothing to do with the number of months. There is no additional information needed for child benefit. So depending which box you choose, you're going to have different box numbers. I recommend you always start with the first box. So do them in order. Remember, if you're looking at a T4AP slip, on the right side of the slip, you have a vertical column. Start at the top and work your way down. So in this case, which you can now do, we're going to have a box 14. Box 14 for Robert is 9030. When I enter that in, it's going to ask me how many months was he retired or was he old enough to collect CPP? And the answer for that is 12. So I have to enter 12. It's going to open another box because he might have had post-retirement. If he had had post-retirement benefits, I would then go choose the next one. I want you to notice you get one data entry per box, so you can only have one T4AP in a year. So if you put retirement benefit in, you've used it up. You can't put another retirement benefit. But he might have had a post-retirement benefit. I could choose post-retirement benefit and put something in there if I wanted to. Okay. So then we have to think about what else is on the slip. So if he had paid, if he had some tax withheld, we're going to make a note of his box 22. In this case, it's 1200. It is possible you could be getting slips for QPP. If you are, however, I recommend that you get someone who has done Quebec returns to help you with that one. More commonly in Manitoba, we're going to see very straightforward slips. Okay. So we're going to enter his T4A, box 14, 12 months, and he had some tax withheld. Double check our numbers, give ourselves a check mark for it. We can then switch to Margaret. Margaret also had some CPP. She had less. Most likely she worked less than he did, so she has contributed less to CPP, so she can draw less from CPP. Again, she had a box 14, so I'm going to choose box 14. Then I need pension. How many months? 12. She did not have any tax withheld, so I'm going to put a check mark there. That's it. And then we can go take a look at the return and see what that did. So now I'm expecting to see two lines. For Margaret, I have old age security and I have CPP. And then for Robert, I'm going to have old age security and CPP, and I'm going to have some tax deducted. Okay. What is our refund for Margaret or for Robert rather at this point? Okay, if you all got 1554.87, then you have done your data entry correctly, most likely. Again, going to model good behavior here. We're not just going to look at the tax return. We're also going to look at notes and diagnostics, and we're going to see if there are any notes and warnings and things that we need to deal with. So you're going to notice that I shouldn't have any of the warnings that are things I need to clear. My e-file only says it's ineligible because of one bullet, which is because the e-file setup is incomplete. But I do have one more new warning now, which is that the taxpayer may be eligible for guaranteed income supplement. It's warning you there's the possibility that they are eligible for that program. If that's the case, they don't need to do anything. They're just going to file a return. But it is a good idea to let your clients know if they're in a scenario where they might be getting mail from the CRA, that they can come in and talk to us about that. Generally speaking, they don't need to do any separate application. They just file a return, and automatically they will be signed up for guaranteed income supplement. They will, however, getting a letter telling them about that. So it's not good to surprise your clients with letters from the government that they weren't expecting to get. Let them know this is what's likely to happen. And then you can tell them you don't need to fill in a separate form. It's already taken care of. All right. There are a couple of complications which I will refer to. They are in the book. You can go to the book for more details. What happens when your client has filed a CPT 30? If they have elected to stop contributing, but so in that case, they've done a CPT 30, they've given it to their employer has to send that into the CRA. If the employer calculates CPP incorrectly, if they keep taking CPP withholding off after they've already filed a CPT 30 saying don't do that, you might end up with an e-file error in that case. That's something that's completely beyond our control. We can't fix that ourselves in our computer. However, there is a CRA e-file help desk. So what happens in that scenario is you will get an error code of a specific type. That error code will tell you there's a discrepancy because CPP was being withheld, but they had elected to stop it. We can then contact the e-file help desk and obtain the effective date for the contribution stop, and they will be able to help us fix our data entry to make it work so that it will e-file. We should also then contact the employer and make sure that they're doing their payroll correctly. Okay. There are some keywords, if you're sort of poking around and you're looking for them, there are some keywords for CPT 20 and CPT 30, which will generate blank forms for you. That being said, those forms are not very helpful because they don't have any information and we can't file them electronically anyway. So in most scenarios, if I had to help a client with a CPT 20 or a CPT 30, I would be using the fillable forms for that. Okay. So we've done the easy stuff. Let's jump into starting into some of the more complicated ones. We're going to start talking about other sources of pension income, and we're going to use a T4A. Here is a place where it can be really useful for you to have your chart that you had when we were learning about pension income and groups, because the data entry has to match the reality of where you want things to go on the return. So you can't trust the computer to put things in the right place because you're the one telling the computer the information it needs to know. You need to make those decisions yourself first and then look at it. So whenever you're dealing with T4A pension income or RIF income or all of those sorts of things, it doesn't hurt to have a copy of that information page, pensionable income and charts and all the group numbers that we practiced with as you're doing your data entry as well. And I'll show you why in just a minute. So we're going to start with a T4A. We have a T4A for Robert, and Robert is going to have something from CIBC Mellon Trust. So I'm going to find a T4A here. This time I do want the name because he might have multiple different sources of pension, and I want to keep them all straight. So I'm going to put that in there. You're going to notice we have lots of different options. We've looked at a few of these already for other employment income and similar things there. We've talked about patronage. We're going to talk about pension income today. If it's a box 16, you have a drop-down box and you get to make a choice about what type of pension it is. If it's from a registered pension plan, you're going to pick the first one. That's the most common one that we do. But they might be receiving income from a Saskatchewan pension plan. If that's what's happening, you need to change your box 16 to say Saskatchewan pension plan. Remember, it's not going to say a different thing in the slip box 16. You'll have to identify. Now, if it's Saskatchewan pension plan, it will say Saskatchewan pension plan as the person who's paying it out. So that will be different. You might have some additional information as well. If you're getting into really complicated ones like veterans benefits, eligible for pension split and things like that, you might want to go and do a little digging and a little research first. Again, most commonly, box 16 is just RPP, but don't assume. Make sure you've decided for yourself what is the source of this pension income. We might also have lump sums. Lump sums get fun because now we have to talk about, does it matter if we're in a group? Does it matter if it was transferred or not transferred? How does that work? So if it's a lump sum that you can't transfer, it'll be a box 108, and you're going to put it in a box 108. You have a box 18 and a box 108. You might have a box 18 and a box 190. You might have a box 18 and a box 102, and you have to decide whether it is non-resident. If it's non-resident, you shouldn't be doing that return. But there are all kinds of different things. The data entry will put lines on things on different line numbers. So if you remember doing this by hand, you had to decide, I have this box and I have this group. What line does it go on the tax return? That's what you're doing when you're doing your data entry. You're telling people which box it's in. Most of the time, if it's a lump sum payment from registered pension plan, will that be eligible for the pension income amount? Does anyone remember lump sum payments? Are they usually eligible for pension income amount? Yes or no? No, which means they won't get a pension income amount and it will not be eligible for splitting. All of those things happen just by choosing this box. When I pick that box, I am telling the computer there's no pension income amount connected to this, and this amount of money cannot be split in a pension split. Right? You might have a T4A annuities. If you have a T4A annuity, you're going to have a box 24, and then you have to pick what type of box 24 it is. And if it's annuity payments because of the death of a spouse, because you're in group 2, you need to make sure you've chosen that you're in group 2. If it is an IAAC and you're in group 2, you need to tell the computer you're in group 2. If you tell the computer you're in group 1, well, if you tell the computer it's a normal one and your age is under 65, it will put you in group 3. And then it might not be splittable, but if you're actually in group 2, you're going to have that option. Or if it's an ordinary pension annuity, if you're in group 1, it doesn't matter. The computer knows that because of your age. If you're in group 3, you're going to choose this, and your age will put you in group 3. If you're in group 2, you have to choose the death of spouse option. Does that make sense? Does everyone see how that works? If you know which group you're in, age will determine it. The computer knows the age of the client, but it doesn't know death of the spouse. You have to tell it death of the spouse if that's relevant. Okay, and you might have a pooled registered pension plan. If you do, you're going to choose whether it's pooled registered pension plan and you're in group 1 or group 3, or if it's because of death of a spouse and you're receiving that income and you're in group 2, you're going to tell the computer you're in group 2. Okay, so I think that is most of what I wanted to say about that. So let's do the straightforward, comfortable pension that we have, which is box 16. In this case, it's from his registered pension plan, so we're going to choose the first option, 19,500. You might have some other boxes that are relevant to the tax return. Again, anything that you can't find on your list here is going to be in other income. And we may have two different ones that you might see. You might have medical premium benefits, and you might have premiums paid to a group life term insurance plan. If it's medical premium benefits, it is taxable income because they are receiving benefits related to employment. It will go on the other income line. What can you do with medical premium benefits on a tax return? Assuming they have enough other medical expenses, what could you do with them? Claim them as a medical expense. You might have to do that data entry manually. If you have to do that data entry manually, don't forget to do it. Or it might not be medical premium. It might be premiums paid to a group term life insurance plan, box 119. That's what he has. I'm going to choose that. I'm going to put it in. What can I do with that? Is there anything I can do with life insurance premiums on a tax return? No. Good. That was one of my trick questions. Clients will say, I would like a credit for that, please. And you will say, nope, it's just income. The benefit of life insurance is something you receive after you die, or rather, your beneficiaries receive it after you die. For you, this is taxable. All right. And then something to remember as well, he may have had, probably has had tax deducted from some of that pension. So we're going to put that in as well. Find your box 22. There it goes. In this case, I'm going to double check. So I've done box 16. I've chosen an option, which is registered pension plan. It's going to put it in the correct place. It's going to tell me that it's pensionable income. I'm going to get a pension income amount for it, and it will be eligible for splitting. It's going to give me premiums. That's going to go on the tax return as taxable income, and I now have some tax deducted. Do my quality at source, and what I would like you to do is go to the tax return and see where all of those numbers went. So I'm going to go in here now. And I'm now going to have what we had before, which was our OAS and CPP. I've added in some other employment income. If I have other employment income, what non-refundable tax credit am I going to get? Other employment income gives me Canada employment amount. You probably forgot that that happened. The computer remembered because we put it in the correct place. So I have added income to his return, but I have also given him a tax credit connected to that. And this was something that the computer probably remembered that you might have forgotten if you were doing this one by hand. All right, and I should have pension income now on line 19 or 11500. Because he is old enough to be eligible for pension annuity income, he has received it. Again, I like to confirm this with my own chart just to say, did this go where I expected it to go? Yes, it did. If it didn't, I probably need to go back and change my data entry. And then at the very, very end, we now have some additional tax deducted. And if I want to know what tax was deducted, I can look at my worksheet and it will tell me that I had some from the T4AP and some from the RPP. Okay. Are there any questions about entering pension income from a T4A slip? Nope. Okay. So let's go in again, and I'm going to look at the next type of income that we have, and I'm going to do these a little bit out of order based on what you're going to get in your slides, but I'm trying to limit the amount of flipping between different things that we do, and I'm also trying to follow the where things go on a tax return. So we're going to talk now about U.S. Social Security benefits. Again, just a reminder, most of the time when we're dealing with foreign pension income, you do need someone who has a bit more experience in dealing with foreign income and foreign tax withheld. So most of the time, we would not recommend doing those returns without some assistance. U.S. Social Security is the exception to the rule because it is so common. It is something that you should know how to do, and I'm going to show you the data entry for that. So we're going to notice in here that Margaret is the one who is receiving U.S. Social Security benefits. She will have received an American tax slip. It is a U.S. form, SSA 1099, and we'll have to find out a little bit of information about when she started receiving those benefits. But I will tell you, based on her age, there is zero possibility that she is going to have a 50% exempt. She's going to be the person with 15% exempt under the tax treaty. So we just have to make sure the computer handles that correctly. So I'm going to go into Margaret now because it's her income. It's going on her return. And for this section, when we're dealing with any foreign income, we're going to open our Smart Start Assistant and we're going to find our foreign income line. So it's going to be on our income section. So we've got our regular income, we've got employment income, T-slips, investments, Canadian source income, and then underneath we're going to find foreign income there. Okay. Foreign income, most foreign income, I recommend that you not enter. Make sure you have a specialist to help you because there are all kinds of things we need to do. We need to do conversions. We need to determine what is and isn't taxable. If it's foreign business income, that's a return that really needs to go to someone who is very, very specialized. But we do have foreign income pension on the list. So what I would like you to do is find your foreign income. You can use the keyword foreign-inc or open up your Smart Start foreign income. And you're going to notice most of the way down the list, we have foreign income pension. I want you to choose that one. Okay. Foreign income pension is going to ask what country we are in. And when I say what country, we're doing U.S. Social Security. You're going to choose U.S. That is a blue star. You have to enter that in or you're going to have a warning. Okay. I want you to notice that there's an exchange rate, but we're going to start without using it. So most of the time, we would need the exchange rate. But let's see what happens if we don't. I'm going to do pension type is required. And you're going to notice on pension type, we have all kinds of things. If you're picking anything other than U.S. Social Security, please go find a specialist to help you because there are all kinds of considerations you may not have thought of. So we're going to do U.S. Social Security. You have to decide, is she 15% exempt or 50% exempt? She's not old enough to be 50% exempt. She's going to be 15. So we're going to do 15. Then it wants the income amount. And I think it was 2,000, but I will double check with my slips there. Yeah, it was. And that's it. I'm going to leave it there. There will not have been any tax withheld. We already know there's a tax treaty. I don't want to put any extra information in. I do need to make sure that a couple of things have happened. I need to make sure that it's being reported in Canadian dollars, and I need to make sure that it's reporting the exemption correctly. So let's see what it did on the tax return. If I go to the tax return and I look at her pensions, you're going to notice that I said 2,000 and it said 2,507. Okay. Why did it say that? Well, if I go down to my summary of foreign income, I can see that it has applied the exchange rate for me. I didn't have to do anything extra. And that is because it is such a common slip that they have made our data entry easier for us by taking one of the steps out of the process. So I've already done the gross up. I don't need to do a second exchange rate. It's doing it for me. It's going to add the income in to her pension line. Then it's going to take the exempt portion out, which it has calculated for us. We didn't need to do anything. How much of this will she receive a pension income amount for? What will her credit be? You give me a rough ballpark is fine. If I go to my foreign income, I had 2,507 total income. I deducted 376. What will she get the pension income amount for? Can she claim a pension income amount for all of it or just part of it? What's the rule? Only the taxable portion creates it. So very good. Thank you, Helene. It's going to be roughly 2,000 and change, which in this case is going to get to the maximum. She will get the pension income out for herself, which is good to know. But if she had had less, so maybe it wasn't 2,000, maybe it was only 1,000, that might have been more relevant because if it had only been 1,000, then she wouldn't have gotten a full pension income amount. She wouldn't have gotten $1,253.50. She would have gotten $1,253.50 minus the $188.03. So that's why it's important to know. The good news is the computer knew that even if you didn't. So the computer will do that correctly as long as you have told it that this is U.S. Social Security that is 15% exempt. That's your job. Good. Let's take a look at what we're at right now for the tax return. So on Margaret, you should have a refunder balance owing of $491.20. So $491.20. And then on Robert, you should have a refund of $1,105.04. If you have something different, let me know, and we will update that for you. We'll find the problem. Because I've added a lot of things, it's always good when you're halfway through your data entry process just to check each line you've added things to and say, did it go where I want it to go? We need to be looking at the tax return and not just the data entry. Okay, well, I haven't heard otherwise, so I'm going to assume that you are all in the same place that I'm in, which is great. We're going to keep going. So we have now done T4A OASs, we've done T4 APs, we've done foreign income, we've done regular T4A pension income. T4As, you now know how to do basically everything that can come on a T4A that we expect you to do in this class. There's a lot of things on that slip. You're going to find it in multiple different chapters. So if that's stressing you out a little bit, what I would recommend that you do is just go through your textbook once and go, where are all the places where there's T4As? Open up any file that you have and just experiment, poke around and see what boxes there are, which ones do you recognize, and make sure that you're comfortable with the data entry for that. Okay, but we're going to keep going, and we're going to talk about annuities as income as well. So we have done regular pension income. Now we're going to talk about annuity pension income, and we're going to start with T4 RIFs. So again, a new tax slip, you have to find the correct tax slip here. So it's not a T4A anymore. It is a T4 RIF, which is about halfway down, T4 RIF. Not to be confused with the T4 RSP. Again, different data, so you're going to find the wrong things. We want the name because they might have more than one. You could have one RIF at one company and a different RIF at a different one. We want to be able to track our work after the fact. We're going to have different data entry here. Again, we're going to have a taxable amount, and you have to choose which type it is because it's going to change your group. And if you change your group, it can change where it goes on the tax return. You might be receiving it for yourself, or you might be receiving it because of the death of a spouse. So make sure you're making that determination before you do your data entry. In this case, it is his RIF, so we're going to pick taxable amounts for RIF. We're going to come back to this section later today. So when we talk about transfers, we're going to come back to transfers. But for now, we have a box 16. In his case, it's $8,900. I'm going to enter that. There are other things deemed information from a RIF. I don't recommend you do that return. That's going to be too complicated. But you might have income from a RIF where the spouse put the money into the RIF for you. So you might have a box 26. If you do, you want to say yes, and you want to identify who the spouse is. You might have some other things. Again, other income on a RIF is going to happen because someone died. You need a specialist for those. I don't recommend doing those in this course. But very, very commonly, when you have a RIF, you have not only the box 16, you also have an excess amount. That is incredibly common, so make sure you're entering that. Remember, you have to take money out of a RIF. Once you turn a certain age, you are required to start withdrawing from your RIF. They will not deduct tax on the portion that you are required to withdraw, although it is taxable. They won't withhold tax on that. But you could take more out. You don't have to take the minimum. You could take more than the minimum. If you take more than the minimum, you're going to have an excess amount, box 24, and they will deduct tax from the excess amount. So you're going to notice he took $5,000 out more than he needed to, and they took 10% off of the excess. So we're going to have a box 28, which is the tax withheld. We need to enter that as well. Okay. After we've confirmed all of that, I'm going to put a check mark on it. Will this be pensionable for Robert? Would he get a pension income amount for this? Let's negate the fact he has other pension income and he's already hit the maximum. Is this particular thing pensionable? He is in group 1 and he is receiving an annuity payment from a RIF, yes. Which means it is also eligible to split. So when we start talking about pension splitting, we will be demonstrating that this will be included in the pension split as well because we have characterized it correctly. All right, the next question is, where does this go on the tax return? Let's go find out. So I'm going to go to his tax return. I'm going to go to his income line. And now I have an increased amount for his other pension because the RIF income is also on line 11500. And if you want a breakdown, that's what your worksheet is for. Your worksheet in the computer will show you the breakdown for everything you've entered. So if you have a client who has a very complicated retirement scenario with multiple tax slips and you need to verify that you got all of them, what you do in the office is you put the tax slips on your desk, you put them in a pile, you go to your worksheet, and you just tick off everything that you've got. So do I have that number? Yes, I've entered that. Do I have that number? And then if you have any papers left on your desk, you have to go back and do some more data entry. All right. There's our T4 RIF. Again, it's not difficult, except you have to be aware that you are making decisions when you do this. So you are making decisions every time you do data entry here. Make sure those decisions are what you meant for them to be. All right, and the last one we have right now is also some RSP annuity income. RSP can be a lump sum or it can be an annuity. We're going to have a T4 RSP. Anytime you take money out of a T4 RSP, you're going to have a tax slip for it. Let's open up a T4 RSP. We're going to talk about that. I'm going to put RBC in just so that I remember that I have to do it, but I'm going to point to a few other things first. So you can have lots of different things from an RSP. You could have an RSP annuity, which he does. We're going to get back to that. If you have an RSP annuity, he could take some excess out as well. We would have a box 20 in that case. You could have a regular withdrawal. So this is a lump sum withdrawal. And when you do that, we're going to come back to this later. It might be a regular withdrawal. It might be an early spousal withdrawal. So we'll be talking about how to do the data entry for that. You could take money out under the homebuyer plan or the lifelong learning plan. If you take money out of the homebuyer plan, you have two pieces of data entry. The first is the home that you bought the same as the mailing address on the return? If it is, you are telling the CRA that you moved into the home, which is one of the things that they want. So if he had had a homebuyer plan and I picked this, let's say he took $35,000 out because that's what he can take out. You don't need to do this data entry. I'm just going to show it to you. We would now have a Schedule 7 generated for us. The first part would be blank, but at the end of it, it would say that's the withdrawal and he lived in the home. Is it the same address? If it isn't, I would pick the other one and I would say it is different. And then I would go here and it would not be ticked off, and I would tell my client, expect to get a letter from the CRA asking when you moved in, because if you didn't move in, what does he have to do? If you took a home buyer plan out, used it to buy something, and did not move into the home, what happens? He has to pay it back. So believe me, if that box is not ticked off, he is going to get a letter from the CRA asking for more information. Could be valid. There could be a reason why they haven't moved in yet, or they haven't moved in at the time they filed the tax return, but they have moved in by the time they get the letter. So that's how we do that one. You might have a lifelong learning plan. If you do, did you withdraw it for yourself or for your spouse? We'll get to that again when we talk about students. You're going to have to tell the computer that they are a student, and that will also update their information on the Schedule 7. So those are some very common types of withdrawals you're going to see. but I want to show you the specific one we're going to do for today, which is the pension amount. So in this case, he has a box 16, which is an annuity payment. Again, you have the option to choose, is he in group 1 or group 3? Group 1 or 3 is going to be based on his age. If he's in group 2, you have to tell the computer he's in group 2 by choosing death of a spouse. And again, we're going to come back to the idea of transfers later on today, but let's make it easy. We'll do box 16. He took annuity payments out because he had to take annuity payments out. And if he had some tax withheld, this time it's box 30. I would not have memorized that, but I can see my keyword FIT is where I put my withdrawals or tax withheld, and it will say box 30 on the slip. I'm going to put 460 there. I'm going to double check my data entry. We're going to go to the tax return. We're going to see what that did. It is an annuity. He is in group 1. It is going to be eligible for the pension income amount. It will be eligible for pension income splitting. And I should now have added it in to my RSP line. So this is going to go on line 12900. Okay, are there any questions about everything we did up until now? Okay, I have one more just thing that I want to talk about. I know it's a lot of information, but it's all in the book. So the nice thing about this is you have your book, which has even pictures of what the data entry looks like. And you're going to get to practice this because we're going to do a whole bunch of problems. We're going to do these ones, and you're going to go back and do 19.1 and 19.2 because now you know how to enter T4 OASs and T4 APs. So you can now finish those as well. So lots of practice after today. I'm going to talk about one more complicated thing that I just want to mention, and again, this is going to be something that can come up. If you have someone who has over-contributed to an RSP, if they have put too much money in an RSP, there are a couple of things that might happen. Can anyone tell me what's the first thing? If you know that that happened this year, it is recent, they have put too much, they've over-contributed their RSP, and it is a new thing, what advice would you give them? Is there a way for them to take the money out without being penalized for the overcontribution? Does anyone remember? So if you just found out that your client overcontributed, you can overcontribute $2,000 before you have to worry about it. But let's say they've overcontributed by $16,000. They got a big lump sum. They thought, I'll put it in my RSPs. They didn't check their limit. They just put $16,000 in. What can they do? They can withdraw it, and I'm going to have you go back to your textbook to look into the rules for this. You may have forgotten it. There's an expiry time limit on this. There is a limited amount of time where you can withdraw it and ask for it to be taken out without there being a penalty. Okay. If they have time to do it, they need to file a Form 3012A, so a 3012A. In that circumstance, you're going to have a T4 RSP that will have a refund of excess in it. In which case, you're going to get that T4 RSP slip and you're going to enter the refund excess as it is. So in that circumstance, we would have this one, which is a refund of unused contributions. So they have over-contributed, they did not get a deduction for it, but they are being allowed to take it out, and it will be added to their income because they have taken the money out. It's going to be on a T4 RSP, but they get a deduction for the portion that they're entitled to, and that is determined based on what happened when they filed their T3012A. So you'll get a tax slip, you're going to have some income, which will probably be a lump sum income, and then you're going to have a refund of unused contributions. You're going to enter it as it is, and you will be able to file that return. That's the easy scenario if your client did it that way. So tell your client to do it and then put a note in your file and say next year, keep an eye out, make sure they get the refund of the excess portion. If they don't have time and they have to get the money out before it starts to incur penalties, they can also do an after-the-fact form called a T746. That makes it trickier because what will happen is the income is going to go on the return, and therefore it will be taxable, and they're not going to get the deduction for it. We can't do the entire thing up front. It has to be done by an adjustment. So what we would do is we would fill out a T746. You fill out your T746 using fillable forms with the CRA. So you need to do this one manually. Then you're going to use that calculation to determine what the income adjustment would be. You would enter your box 22 as normal. Then you would have a keyword, and again, this is all in your textbook, so I don't expect you to remember it, but I expect you to know that the problem exists, and if it exists, how do you figure it out? So what you would do is the keyword is additional not the keyword, the section is additional deductions. The keyword is repaid amount. If I go to repaid amount, I'm going to have somewhere down there RSP withdrawal. Where did it go? RSP withdrawal not transferred to an RPP. And then I would be able to do the amount that I calculated manually on my T746. That will take the income out, so they will not be taxed on the income up front. But I still have to file an adjustment with the T746 because I need to get that T746 approved, and I have to ask the CRA to fix their undeducted contributions as well. So what will happen after I've done this is I will definitely have the CRA waiting to get that adjustment from me. When they get the adjustment, they will allow what I've done here, which is the deduction. They will also change the undeducted contributions so that next year they won't have a large undeducted contributions available for them to use because they're not supposed to have it because they took it out in time. If they didn't take it out in time, so if this happened in the past and now it is too late to fix, what is the next thing that happens? Does anyone remember the form that we have to generate if they have over-contributed and we can't take the money out and now they just have penalties? T1 OVP. The keyword is T1 OVP. If you want to create a T1 OVP for your client, you can. You still have to prepare it by hand because you need to know which numbers go on here. The computer will not do any calculations for you. You have to decide what the calculations are. We just have data entry that is nicer than using the fillable forms for every single line. So you're still going to be calculating it manually. If this is the first T1 OVP return they're doing, you're going to say they didn't file one last year. That's going to require certain data entry where you determine your starting figures. T1 OVPs are complicated because they go by the calendar year, but of course all of our RSP information is March to March. So we have to go find our client and get their monthly statements to find out when they made all of their contributions and if they made withdrawals, the dates of those withdrawals. So we do all of that work behind the scenes, figure out what numbers need to go in our T1 OVP, and then we can file our T1 OVP here. The nice thing is if we have to do multiple years, we can do multiple years. And if they did file a previous one, if we're just updating and hopefully this is their last T1 OVP they have to file, then we're going to take those figures from their last T1 OVP, choose file the T1 OVP before, and then it's going to ask us for information here. So if you ever have to do one, do it by hand first. I do these in a spreadsheet because there's so many numbers I have to keep track of. I just create my own spreadsheet for it with the fillable forms, figure out the numbers, but I can now do the data entry in the computer, which makes my life easy. The hard bit is the computer does no calculating for you. You have to do the calculations by hand. And then you have to file it. You cannot file that electronically. T1 OVPs are still paper filed, so we have to then send it to the CRA that way. Good, we're going to take another break because after the break, we're going to get into RSPs and we're going to do early spousal withdrawals and we're going to do transfers. So I'm going to say take a nice long break. We're going to give you probably 10 minutes. So we're going to come back at 11:20. Use this time if you have questions. I will still be here. And after the break, we're going to finish up our RSPs. Welcome back from break. I gave everyone a long break just to make sure we could get back, make sure we're all together on the same place because I added a lot and I took a lot away. So you now have in the chat window, Robert has a balance owing of $841.03. Margaret has a balance owing of $451.84. If you think you agree with me, give me a green check mark. If you have a different number, let me know, because I'm going to continue to add more information at this point. This is the part where I go a little bit off script and I add more details to your data entry. Okay, I see some green check marks. I don't see any red X's, so that's good news. If you do have one, we can stop and fix it. But what I'm going to add now is a little bit more information. I'm going to tell you that Margaret also had a T4 RSP, okay? So she had a T4 RSP, and I'm going to give you some box numbers, which I will type in here. She had a box 22 that said 5,000. And she had a box 30 that said 500. What questions should we be asking when we take a look at that slip? So I'm going to do my download. I'm going to say T4 RSP. And I'm going to tell you that that's TD Bank. And I'm going to do my box 22 and put 5,000. And I'm going to do my withdrawal or tax withheld, which is 500. That's what I will automatically fill on my AFR download. What else should I be looking for? What do we know about Margaret? She didn't work very much in her life. Her spouse did, probably a spousal contribution. So we need to go looking for additional boxes. And if I tell you that she had a box 24 that said yes, and I'm also going to tell you that the spouse connected to that, I have to get this number for you because I don't have it written down. I will tell you that her spouse SIN number on the slip is 870001542. We need to enter that as well. So I'm going to do that. So I'm going to have my T4 RSP, and now I have to say contributing spouse yes, and I need to put the spouse in. It is very important that you put the spouse in because remember, you could have one spouse contribute to your RSP and now be living with a different spouse because maybe you were married and you went to live with your partner who is the parent of your child, and therefore you are common law, so the person who is connected to your file might not be the person who put the money in that account. So you do need to confirm the SIN number. It has to be in the computer or the computer won't know what to do. Now, what's the next question we have to ask? I know that she's withdrawn from a spousal RSP. What do I have to find out? Is it an early spousal withdrawal? I need to find out if Robert has contributed at all in the last 3 years. I don't have an RSP receipt for this year, but that doesn't mean that he didn't contribute in the past. So now I'm going to give you some more information, and I'm going to tell you in Jan-Feb of 2021, which means this was a tax slip he got last year, he contributed 1,000. In 2020, he contributed 800. And in 2019, he contributed 1,200. So now we have a problem because now we have an early spousal withdrawal. Again, if you didn't ask the questions or think about it or notice the box 24, you would have finished your data entry 2 lines ago and you would have just said, here we go, this is what I've got. And what would happen is on Margaret's return, it would say, here we go, she had some RSP income, and off they go. She would get the tax withheld, she would get the RSP income, and we would file her return, and we would not know any differently. However, that is an incorrect tax return with incorrectly reported income. So we have to tell the computer now about those contributions. I'm going to teach you how to do that. The first thing that I want you to do, make sure you've entered the contributing spouse and the SIN number. If you don't have a SIN number, it will not generate the T2205 because it doesn't know which spouse you're talking about. You need to tell the computer which spouse put the money in the account, so we're going to do that. Then you're going to go down to withdrawal and you're going to change it to early spousal withdrawal. That tells the computer probably we're doing early spousal withdrawal, but it needs more information. So now we're going to give it the additional information. We do this on Robert's return because Robert is the person who made the contributions. So we will need some additional information. I will need an RSP limit for Robert. So I'm going to put that in, and I will tell you that his limit is $7,500. Anytime you're doing RSP info, you have to have an RSP limit, even if it's not relevant to the case. So we need to have an RSP room. So I'll put that in there as well in case anyone is following along. Okay. Then we need some historical contribution data. So for this one, we're talking about spousal plan contributions that he made. So we're going to say spousal plan. And here is where we use some of that data entry that I talked about last time that I said we should not be entering, which is we need to put in historical information. And I'm going to go from the oldest year to the newest year. Okay, so you're going to notice we have some data entry here that says history, past 2 years spousal contributions. So not inclusions, but history, 2-year contrib, and I can choose 2019. 2019 was $1,200. I can then get another box and I can say 2020. 2020 was $800. Those ones are easy because it's by year. The problem that I have now is where do I enter the January, February 2021? And if you remember, there was a memo field that I said you mostly should never use. This is the time you use the memo field. So pretty much the only time you're going to use the memo field is if we need the historical data. It's not going to give him a deduction for this year. He didn't make a contribution for this year, but it's going to tell the computer that in the first 60 days of 2021, he put $1,000 into his spousal plan, and I know which bank he put it into because that's the bank she took the money out of. Okay, so that's going to generate a T2205 if I've done my work correctly. There's one more question I should be asking though. I have looked to see what he put in the last 3 years. What might she have done in the last 3 years that we also have to factor into the early spousal withdrawal? What happens if she did this before? If he had income included in the past, then he gets credit for it now. So we're going to then go into Rep a Client. We're going to look at his previous returns. If they're longtime clients, it's great because we're going to have their early returns so we can see what was done in the past. Otherwise, we have to do some digging. In Rep a Client, take a look. Did he have any additional withdrawals? What happened in a previous year? And after investigating, we're going to find out that in 2019, $1,000 out of that contribution was already attributed back to him. So 2019, he had $1,000 attributed back in that year. So that's where we use our RSP inclusion income data entry for. So history, RSP inclusion, we're going to say which year was it attributed back. It was 2019, and I'm going to say 1,000. Okay, so there's a lot of steps to make the early spousal withdrawal happen. I'm going to refresh those steps once for you. We start with Margaret because she's the one who received the slip. We download the slip. It's just going to download the box 22 and the box 30, and it's going to say that it was a regular withdrawal unless we say otherwise. We look at the tax slip. We notice it was a spousal plan. We notice that the spouse is Robert. And then we find out, did he put money in? We go into his history. He did. I'm going to change this to early spousal withdrawal. Enter the spouse. Yes, spouse's SIN number. Then I go into Robert's file. I'm going to put his room and limit in because I have to have that. If I'm going to do any RSP data entry, I need a room and limit. Then I'm going to go into spousal plan because all of this happened because he put money into a spousal plan. I have my history. 2021, January, February, that's what the memo is for. It's telling the computers he put 1,000 in that year. In 2020 and 2019, I put his contributions in, and he already had some income included in 2019. I'm going to give him credit for that. If I've done my work correctly, when I go to the tax return now, I will have, if I can find it, on Margaret, a T2205. And on Margaret's, on my T2205, it will have her as the person who is the annuitant. He is the contributor. So she's the annuitant. He's the contributor. She took 5,000 out. He put 3,000 in the last 3 years. He's had 1,000 already attributed back to him, so he gets credit for that. 2,000 of that withdrawal is his income. He'll put 2,000 on his return. She'll put 3,000 on hers. What happens to the tax withheld? Who gets the tax withheld? Margaret gets all of it. Okay, so I want you to make sure that that happened. If that's what happened on yours, give me a smiley face. If it didn't happen on yours, give me a red X and we will fix the data entry. This is going to be your one opportunity to practice this, so we want to make sure everyone's had a chance to do it. And while I am saying that, I am going to stress again that the computer will not do this for you. You have to identify that there is an early spousal withdrawal. You have to go find the information, then you have to go tell the computer all of the things. All right. Seeing some good, successful, happy students who have had a chance to do it. You might want to bookmark this file in your own mind, so if you have to come back and study, you have a good example on your home computer to see what it looks like. If you want to practice these, you can practice them. The same thing that we would do where you set up a file, use one of your other files you've already done, one of your practice files, and imagine someone with spouses. Imagine that someone took some money out, and imagine that someone had put some money in, and see if you can make it match what you would have done on a fillable form. If you do that and you want me to look at it, give me your exercise, give me your assumptions, tell me how much money they took out, how much tax was withheld, tell me how much they contributed in which years. I will look at your data entry for you and correct anything I need to correct. So if you want more practice, this is an opportunity to do that. All right, so that is early spousal withdrawals. That's the first tricky thing we were going to deal with for RSPs. The next thing we're going to deal with for RSPs is transfers. And for that one, I would like you to go into another file. So we're going to look at a couple of different files for this one. I'm going to start with Lillian Richards. So if you can open Lillian Richards, I'm going to give you some additional information for Lillian. And that's going to be the information down here. Remember, Lillian was widowed. Sometimes what happens is most things are sorted out the year that the person dies, but every now and again, something will take a little bit longer to happen, and you're going to get a tax slip after the fact, and you're going to have to deal with it then. So in this scenario, what we have is a T4 RSP from the Royal Bank with a box 18, which is $55,000. So what I would like you to do is in Lillian's file, you're going to enter that T5 slip, and we're going to see what that does to the tax return, or T4 RSP slip rather. T4 RSP, it is Royal Bank. We have a box 18, which is a refund of premiums to spouse. And we're going to enter it in. Okay. There will not have been tax withheld off of that. We would not expect to see any tax withheld. We just have a box 18. As soon as I do that, what's going to happen to her tax return? Oh, this isn't my Lillian Richards file. I am clearing my warnings. She's going to owe. Why is she going to owe? Well, because we've added $55,000 of income to her return that has not been taxed. So if you did that correctly, that is what will happen. However, in real life, what do you think happened? So we have a tax slip. It says that she had refunded premiums. What might she have done? Remember, you can transfer things. Most of the time, it has to be a direct transfer, but there are some exceptions. An indirect transfer is an option. What should we be looking for in this case? If she took that $55,000 and she used it to buy an RRSP, we can do an indirect transfer. So we are looking now for a $55,000 RRSP receipt. So let's assume that we have an RRSP receipt of $55,000. Now this is very important. I cannot stress this enough. Remember, the theory is the income and the receipt must be attached together. So if you have a transfer, then the receipt and the income have to happen at the same time or in the same tax year. Okay? So if her income happened in 2021, we're going to have a receipt for 2021. In the same way that you're going to attach them in terms of which return they get reported on, you're also going to attach them together in terms of how you do your data entry. Okay? If we're doing transfers, you should never put that receipt in the RSP deduction section. Remember, anything in RSP deductions is going to affect your room and limit. So if I took the autofill my return download, if I just downloaded from autofill my return, it's going to put the RSP receipt in here. It's going to put the tax slip in here. And I'm now going to have a problem because, and I do not want you to do this because this is wrong, but I'm going to show you what it would look like. If she had contributions, 55,000, and I'm going to say test because this is incorrect. If I put the receipt in where it's going to automatically download, I'm going to have the income of 55,000, but when I get to my Schedule 7, I'm going to have a problem. Because it's going to show me the contributions, which is correct. I do want to see it there. But when I get down here, it's not going to do the transfer for me. It's going to use up the room. And then it's going to say she's over-contributed $46,000, which is a problem. Because now we have to do T1 OVPs and penalties and all of those things. So we're never, ever going to do the data entry for a transfer in this section. I'm going to take this out because this is definitely wrong. And I'm going to remind you, we always want to connect the RSP receipt that's being transferred to the income. So I have to go find the income slip, and I'm going to open it up. If you go to T for RSP, you're going to notice underneath refunded premiums to spouse, I have a second refunded premiums line. This is where I'm going to tell the computer how much was transferred. If she transferred 55,000, that's what I'm going to tell it she transferred. So I now have one line that says refunded premiums to spouse and one line that says direct or indirect transfer. This was an indirect transfer. I have the receipt. If I go to the tax return now, you're going to notice I still have the income on the return. I still have the contributions on the return. But instead of using my room, it has given me a $55,000 transfer. Now that I have a $55,000 transfer, I also have a $58,600 deduction and no carry forward, no over-contribution. What will happen to her refund or balance owing? So again, the income is still there, but now I have a much bigger RSP deduction. It should go back to original. Now, I can't 100% guarantee that this is the right number because it looks like another instructor has changed some numbers in my file. So hopefully, at least I want you to make sure that it makes sense, that it is close to what it was before. Okay, and I apologize for that. I will see if I have that in my personal one. I brought my other laptop. I can't show it to you on the screen, but at least I can confirm. It should be 1327.39. Okay. So I apologize. My data is a little bit incorrect here, but the result is what it should be. And I'll see if I can correct that before the end of today as well. What you're looking for on here are the two line numbers, which I'm just going to scroll up to find. You're looking for RSP deduction of $58,600 if you have that, and you're looking for income of $55,000 added. You should have the right amounts. Okay. So that's what it would look like if we were doing a refund of premiums situation. Again, if this is happening in real life, hopefully you would notice that there was a problem with your file, because if you tell a client that they owe $22,000 or more, they're going to want to know why. And at that point, you might notice that you didn't do the transfer correctly. But I will say, more commonly, every time you see a very, very large amount of income that is from an RSP, think about whether or not it's a transfer. If you see a large amount of income that's from retiring allowance, think about whether or not there's a transfer and go looking for that transfer. Okay. It is never, ever entered under RSP deduction, because if you enter it under RSP deduction, you're going to end up with using up the room and creating overcontributions, which we don't want to do. Okay. I'm going to demonstrate on another file how we would do this with eligible retiring allowance, but it's going to be pretty much handled the same way. So you can pick any file that has a T4 in it if you want to experiment on your own. I'm going to go into Mary Murray because that's just a very useful one for me. You won't have this file already set up because you didn't do this one on the computer because you didn't need to. But I'm going to say, let's assume that when we get to Mary Murray, or whichever file you're picking, what would happen if she had a retiring allowance? Because a retiring allowance is a transfer that I do expect you're going to see. And you're going to have this option. Is it an eligible retiring allowance? Yes. Let's assume she has a retiring allowance of $10,000. She might also have a non-eligible retiring allowance. If she does, we would have an extra amount there. I'm not going to worry about it for today because you don't always. What will happen if I enter the T4 now is we're going to add $10,000 of income to that return. And that will be other income. So retiring allowances are other income. If your client has a retiring allowance, you should be looking for an RSP receipt. Okay? If you have an RSP receipt, where will you enter your RSP receipt? Let's assume that Mary has a retiring allowance of $10,000 and an RSP receipt of $10,000. I'm going to give her an RSP limit while I'm in here. Where should I be entering her RSP receipt? See, a brave volunteer. I have a retiring allowance. It is eligible to be transferred. I have an RSP receipt for the year. What should I do? Should I use her room or should I do a transfer? I should do a transfer, and I'm going to do the transfer on the receipt. Excellent. So I'm going to open up her T4, and underneath eligible retiring, I'm going to say how much she transferred. If she transferred it, you do not want to use portion transfer January, February 2021. I will talk about why you don't want to use that in a minute, but you should be, if you're doing this correctly, choosing the first one, direct or indirect transfer to RSP. And if I do 10,000, I don't have to do any additional data entry. I'm going to go into the tax return, and now she's going to have 10,000 for her other income. On a Schedule 7, she's going to have $10,000 of contributions. Her room is $3,000, but I'm doing a transfer. She's going to get the full deduction I'm not even touching her room. She gets to keep that room. She'll have it in the future. There's no over contributions. And it should not change the number on her tax return at all because we have given her the same deduction that we had for income. All right, I'm going to change the scenario a little bit. What if she didn't have a $10,000 receipt? What if she only had a $5,000 receipt? So what if the receipt was $5,000? What will I do with that $5,000? That would be the transfer amount. Excellent. So I always have people who get confused and they go, you have to transfer 10, and if you didn't transfer 10, you don't get it. Nope, I'm going to transfer as much as I can. So how much can I transfer? I can transfer up to 10,000. So I'm going to say 5,000. Now I will have a $5,000 transfer, and she'll have an extra $5,000 of taxable income because she didn't put the rest of it in an RSP. Good. What if she has a receipt, and this is where it gets tricky a little bit. What if she has a receipt for $12,000? What do I do with the $12,000 receipt? Very, very, very good. So $12,000 receipt. I can transfer 10, so I'm going to transfer 10. And this, it messes with people's heads because you're doing data entry that doesn't look like the slip in front of you, but that's fine. We're not doing data entry, we're doing a tax return. So I'm going to enter 10,000, and then I'm going to go down here and I'm going to say in her own plan, she has also contributed 2,000, and I might put a note. So I'll put a note in somewhere saying 10,000 was transferred, 2,000 used her room, so that when I go back to it, I can find it later. In that case, I will have on my RSP deduction, you'll notice 12,000 contributions, which is correct, and 10,000 transfer because she can transfer 10. I'm going to use 2,000 of her room. She'll get the total deduction of 12,000 and have no carry forward. So the computer will do it correctly. Good. I'm going to give you one more complicated thing, which will mess with people's heads a little bit. And I'm going to take this out. And I'm going to take this out. And I'm going to say, what if she has two receipts? She has one receipt for 8,000 and one receipt for 4,000. Now, what do I do? Really, really good theory reminder of how we handle this in real life, and then we make the computer do what we want it to be. I'm going to enter as much transfer as I can. So I'm going to say I can transfer 10. How much is left over? 2 is left over. I'm going to do 2 using my room. And it's going to look exactly like it did before. And then I'm going to put a note going, I have 2 receipts, one for 8,000, one for 4,000. I've transferred 10,000 total. The remainder is using the room. So again, I go back and I have that explanation there. Good. I'm going to take all of this out, and then I'm going to talk about the one more complicated thing that will happen. Okay. What will happen? Would I use notes or paperclip? I would use paperclip for that one, just because I want to tie it to the actual RSP line, because I don't really need to know that if I'm just looking at it briefly, but if I'm going back and investigating RSPs, that's where I'm going to find it. There's no reason not to use notes annual. The only one I wouldn't do is the note carry forward, because that's not helpful. I don't want to have that showing up every year. It's only relevant to this tax year. So notes annual is fine. I would probably do paperclip, but that's just my habit of knowing where to look for things. I'm going to take these lines out, and what I'm going to ask now is, what would we do in this scenario if Mary had retired or left her company in January of 2022 and has an RSP receipt in 2022 related to that severance package? So what would we do in this scenario if we knew she was going to be getting an eligible retiring allowance in 2022, of 10,000 and she has an RSP receipt for 10,000. What would you enter in the computer? So if she receives the severance income in 2022, what tax year will the income be on? It'll be on 2022. So when should I enter the RSP receipt? I have to attach it to the income. It's going to say January, February 2022. It's going to show up in my downloads now. What will I do with that download? Because if I put it here, my options are 2021 to put it in the room and limit section, which I don't want to do. I can't attach the tax slip. The tax slip doesn't exist yet. It will exist next year. I want to not claim that RSP. This is so important. Do not enter it. This is where you use a carry forward note. So in this scenario, I have downloaded a T4 RSP receipt, or sorry, not a T4 RSP. I have downloaded an RSP receipt for January, February of 2022. I can't use it this year. It is connected to a transfer. I would go into notes and I would say, taxpayer has retiring allowance for 2022 from Jan Feb, RSP receipt for Jan Feb 2022, let's say it was 10,000, will be a transfer on the 2022 return. Then next year, so I do not enter it. If it's being downloaded, I don't enter it into my computer anywhere. Next year, I will go in, I will have the receipt, and I will say eligible retiring allowance the same way that I normally do. They want to be connected to each other. This often doesn't happen correctly. So it is occasionally a situation where someone has created an RSP receipt that they shouldn't have and have left it as undeducted contributions. There is data entry in your computer to show you how to handle that specifically for retiring allowances. So because it happens so often, we have a workaround for retiring allowances. It's a little bit messy. I will show it to you, but you should never use it. You're only going to use this if it was done wrong in the first place, which we shouldn't do. But let's assume, and I don't want you to practice this because, again, you really shouldn't be doing it. Let's assume that when we downloaded her information, we had in her own plan, we had undeducted contributions, and it downloads from previous years of 10,000, okay? And now this year, we have her retiring allowance, which is box 66 of 10,000, and they really should have been connected together, and they weren't done correctly. I will tell you most of the time, if it was done incorrectly, they also didn't save it as undeducted contributions, so we have a bigger problem. We have to fix that with adjustments. And it's messy and it will take time, so try not to do that. But let's say they didn't know that they needed to save the receipt. They thought they had to enter it, but they knew it was going to be a transfer, so they left it undeducted. In that rare circumstance, what I could do to be able to do it correctly for this year without having to do an adjustment is I could change it to January, February of this year, and then I could say portion transfer from January, February. And theoretically, my computer should allow that transfer to happen. So it will show the contributions as undeducted contributions, which it shouldn't have been, but that's what the CRA records say. And then it will allow me to do the transfer with that very, very specific data entry. But again, this is only what happens if they did it wrong, but not completely wrong. Most of the time what would have happened is they would have just applied it using some of the room, which they shouldn't have done, and now we have to go back and fix it with adjustments anyway. So what I will say is, it is messy. Make sure you're thinking about your retiring allowances ahead of time. This will already have happened. Your client will tell you, I mean, if you see a big RSP receipt, a big lump sum RSP receipt for someone who's never done one, ask them why they did it. And they go, oh yeah, no, my employer said I had this thing that I should do. and then you go, okay, you might have a retiring allowance, you dig into it a little bit, save it, connect it to the receipt, give yourself a carry forward note, and you'll be able to do it next year. Okay, that's the trickiest thing that we were going to do today. The one thing that I haven't done is pension split because we have mostly run out of time, but this was important. We're going to have time next class. What I would like to do is show you a couple of quick things about pension split in the 5 minutes we have left, and I may update it with a few other things after that. So I'm going to go back now into my Robert and Margaret Marshall file. We've been talking about the fact that things are eligible for splitting. What will happen in the computer if you have joined files is it will split them automatically for you unless you tell it not to, and it will decide what the best split is. So if you go back into their file quickly, you're going to notice that they are getting a pension split even though you didn't know that you didn't ask it to do one. It has determined in this case that it's going to split $16,500 off of Robert's file and given it to Margaret. And if I go into Margaret, she's going to have $16,500 added to her split pension. And it's going to generate your T1032, which will also calculate out how much they can split. It will calculate the tax that's being split, how much tax goes to each person, and a signature page that they will be signing. What I would like you to notice is there's a really useful report. So anytime there's a pension split, the computer will do it if it can, but it's going to have a report on split pension income here. Spend a little bit of time. We'll come back and look at this next class, but as you're working on your practice problems, you can work ahead. It's going to show you what the return would have been like without splitting and what the return looks like with the split. And then the column in the middle is going to say, this is improving their tax situation, and this is making it worse. So it's going to add lines and take lines away, and the net result at the bottom is how much money are they saving collectively as a family by doing the pension split. In this case, should be $1,195. So if they didn't do the split, there would have been a balance owing for Robert and nothing for Margaret, and the net family result would be $3,936. With the pension split, there's a balance owing for each of them, but it is a smaller balance owing for the family as a whole, so they're saving money. I would like you to notice that the net income line is important. So when I do the pension split, I'm taking Margaret's income from $15,000 to $31,000. I will show you next class how to override that if you need to override it. But this is a page that you can use. So you can now work on your practice problems. There are a lot of them because we're going to go back and we're going to do the 2 Chapter 19 ones that we didn't do. So I will give you these answers. You're going to have Olaf, you're going to have Alan and Janet, you're going to have Ted and Lisa, you're going to have multiple year returns for them. They're getting more complicated, so I'm adding more questions. I want you to keep thinking about them as a full human being or a full family and start thinking about the tax returns beyond just what's in front of you. And then I've also added in the Peter and Lynn Gates and Richard Gates file and the Wesley and Sandra Ames and Madeline Hammond files, so you can practice those ones as well. Please do answer the questions ahead of next class. I would like to be able to go through them and use that as some demonstrations. The more complicated the data entry we do, the more things you need to start thinking about. All right, so we're going to stop there. We're going to finish up the pension split next time, but you have everything you need to do your practice problems. I will see you all on Wednesday.